Tracing over a third of Monday's plunge. The Fed is said to weigh tighter regulation for mid-sized banks following the collapse of three lenders in a week. We'll bring you the opening share prices of European banks in just a moment. Plus, the Chancellor, Jeremy Hunt, will pledge to drive growth by unlocking business investment in his first UK budget. His speech will be set against a backdrop of mass worker strikes today. So let's take a look at the futures. They do seem to be swinging between small losses and small gains. For the moment, a little bit of pressure across the Euro Stoxx 50 futures down 0.1%. Look, overall, financials yesterday were actually some of the biggest gainers that we saw in the U.S. So it's very clear that investors seem to start to wager that the worst route for financial stocks is over. What that means for the Fed is still unclear. I'm seeing more and more research notes saying, look, we're talking about a pause from the Fed, or certainly a less big hike than expected. But if they don't do enough to quell inflation, it could also spell panic because they see something ugly out there. Commodities pretty much stable, certainly compared to yesterday. Brent crude 78.38. Interesting to look at some of the equity futures and the other stories. Of course, traders trying to figure out what's going on with China. There was a slew of economic data where retail sales rose as much as estimated, while factory output was actually fractionally lower than projected. So we're just waiting for the France, the CAC 40 just opening down 0.3%. The FTSE also down by a similar amount. Let's also look at treasuries because that will drive a lot of the money market, or certainly a lot of the sentiment. And we could also look at dollars. So a gauge of dollar strength rising slightly after declining for a fourth straight day. And you can also see Treasuries, one of the main things we've been watching out in this financial rout and fallout, the U.S. 2-year 4.3693. So we begin with the fallout over SVB, and Bank of America has mopped up more than $15 billion in new deposits in a matter of days. Now, that's after the collapse of three smaller banks dented confidence in the safety of regional lenders. While staying with the banks, HSBC is cutting the pay base it offers to some bankers in the UK by 25%, but that's ahead of a rule change that would allow higher bonuses. Well, joining us now is Michael Moore. He's Bloomberg's managing editor for EMEA Finance. Mike, thank you so much for joining us. I mean, it's incredible the amount of flows that actually Bank of America had, 15 billion. Are we expecting more numbers like this from the big four?
I think we are. You know, there was definitely a rush to safety, and the big guys are seen as safe, both because of their size, but also the diversification of their deposit base. They don't have that concentration that some of the regionals have. So I think you are going to see that. And I think, you know, there had been this concern toward the end of last year about the big banks' profitability on some of those deposits. They're going to have to pass more of the rate hikes on to depositors. I wonder if this changes the calculus if they're seeing these big flows.
And at the same time, we're also hearing that the Fed may look at, you know, more oversight for some of these mid-sized banks. What does that look like?
Yeah, I think that could come in a number of ways. The stress tests, some of them don't have to participate, some don't have to participate every year. So you could see more banks added to that. I think there were 34 banks in last year's Dodd-Frank stress test. You could see that number rise. And then, you know, the liquidity coverage ratio, that's something that all the big banks have to keep an eye on. Some of the smaller banks, SVB was not subject to that. You know, that's something that would have perhaps flagged this risk of deposit outflows, and they would have had to hold more cash against that. You know, the big concern a few years ago when they started to roll back some of the regulation is this hurting, you know, these mid-sized banks at the expense of the big ones? But now I think, they're rethinking that.
I mean, I don't want to cry victory too early, but it does seem like certainly it's a smaller, a more stable market for now for the banks. And then we have the story, which is actually our most read on the Bloomberg terminal, about HSBC cutting base pay for some bankers. But this is because they can increase their bonuses. So are bankers getting paid less, or it's just how you pay them?
Yeah, I think the mix is changing. That was the big question we had last fall when the UK decided to scrap the bonus cap, or at least start moving in that direction. The question was, how will banks respond? Because a lot of bankers have gotten used to that higher base pay. And so you may see some firms kind of across the board say, we're cutting base pay because of this. But this might be the approach we see more often, which as people get promoted, it's to the increase is not as great. So over time, they start to bring the salaries down and move more toward the bonus.
Mike, thank you so much. Michael Moore there, of course, who oversees all of our finance coverage for EMEA. Now, another hot U.S. inflation report tilting bets back towards a Fed rate hike next week, even as concerns linger over financial fallout from the collapse of 3 banks in 5 days. Well, joining us now is Jane Foley, head of FX strategy at Rabobank. Jane, I've been wanting to speak to you all week. How do you see the Silicon Valley Bank demise impacting Fed thinking going forward?
Well, to be honest, it's a little bit easier to answer that question today than perhaps it was earlier on in the week, because, of course, we are seeing conditions settle down, and that is likely to see the market refocus its attention, and, of course, the Fed refocus attention back on inflation. And it reminds me really of something Bernanke used to say many years ago now, and he would talk about using the right tools for the right job, and monetary policy for inflation, really, and other tools for financial stability. And really, if conditions now remain relatively stable in terms of the banking sector, well, that does really suggest that the Fed certainly could have room to hike interest rates. We're sticking with our 25 basis points call for next week. And interestingly, I think today we've seen that really strong inflation print for Sweden, Swedish krona rallying on the back of that. And of course, we've got the ECB tomorrow too, which is also going to remind us about the issues that central banks have fighting inflation.
So, Jane, basically, as things stand, there's little in the February data to suggest that they should keep their eye off inflation. Is there also danger that if they don't hike at all, it's seen as signaling to the markets actually that they have real concerns, systemic concerns about the banking industry?
I think that's exactly right, and I think that's another reason for them to go ahead and hike next week, as long as, of course, conditions do remain quite stable. But what it does suggest is that, what does that mean for further down the line, further into the summer, later on in the year, for instance? And I think that is a really valid debate, and I think that's going to be pretty interesting to see how the Fed perhaps addresses those concerns at next week's meeting. Because, one thing that all commentators are saying right now is that what we have now is strong evidence that those higher interest rates that we've seen, and there's a lot still coming through that pipeline that were already announced over the last year, that they are having an impact on the real economy, and that will obviously affect the thinking of central bankers.
But Jane, do you think how much will it affect actually where the terminal rate is? And if you look at these secondary effects, and I don't know whether not accounting for example, treasuries in the right way or certain bonds in your holding is a side effect, but it is very clear that it's difficult to go from 1% to 5% without have some kind of ugly event out there in the space of 12 months.
Well, our forecast of the terminal rate is still at 5.5. Now, what's really quite interesting is at the start of last week, in the build-up really to Powell's communiques in the middle of last week, we had a lot of debate about whether or not 6%, even 7% on the terminal rate was likely. Now, clearly this week, that sort of talk's been really put to bed, but we do still have to keep an eye on those inflation indicators, and I think most economists will adhere to the view that they had last week, which was that core inflationary pressures are still likely to be sticky. Labour market shortages haven't changed. Demographics in the US, which are aging, haven't changed. And all of these lead to the likelihood that we're going to have sticky inflation pressures in the services sector particularly. And that is still a valid conversation to have. It will be very interesting to see what sort of guidance, if it's at all new, from the Fed that we get next week, because those questions are still very much out there and unanswered.
But Jane, if you look at the composition of inflation, it does seem that it's core services and a little bit, of course, of food accounting for more than half of headline inflation. Is that historically trickier to get down?
Yes, I mean it's normal for services inflation to be higher than goods inflation. Goods, for instance, are far more subjected to global competition than many services out there. Too, you see a lot more labour cost pass through in services as a result. So, from that point of view, that is the case, and that is that core services sector is something that Powell picked out last week. That is something the Fed is worried about. That is something all economists are worried about. That is still likely to be sticky. The question is, how does the Fed now balance the signs that the higher interest rate regimes are having on the economy with their need to get inflation down? But if the Fed sticks to this view that the right tools for the right jobs, we are looking at more interest rate rises.
And Jane, at the same time, if you look at financial conditions in the U.S., and we will talk about dollar in a second, but financial conditions tightened quite significantly, and that actually helps them at the margins.
It does help them at the margins. Effectively, that's what monetary policies are aiming to do, tighten financial conditions, and there's a lot of factors that influence that. So yes, that does help them in the margin, and perhaps, that will ultimately allow them to perhaps tighten a little bit less, and perhaps people were fearing even at the start of last week. But this is all in the pipeline. This is all up for discussion for the FOMC. It is going to be an interesting debate for them next week, certainly, and also for other central banks such as the ECB this week, the Bank of England next week too. But certainly for the ECB, it does seem quite likely, certainly to us, that 50 basis points is still there, that 25 basis points that we're going to get from the Bank of England, and the market today, pricing in even more interest rate hikes, for central banks like Sweden. So inflation, it seems, is back right there in the headlines for us to focus on again.
Jane, what does that mean for your dollar call from here until the end of the year? Has it changed on the back of SVB?
Well, we have been expecting euro dollar at 106 in the 1 month, and then maybe dipping a little bit lower, but then the dollar to soften towards the end of the year. Now, I think that trajectory is perhaps still there. I think the market's going to come back and fear a little bit more about US inflation in the next couple of weeks, which could support the dollar. But hopefully by the end of the year, that tightening cycle will be done, and I think the dollar can soften off into the end of the year.
All right, sterling. It is UK budget day, and we don't want to forget that. What are you expecting, Jane?
Well, sterling's done pretty well over the last month. Economic data for the UK has been better than expected, and it seems a very unfamiliar phrase for me to say that because sterling's been on the back foot for so long, but it has performed well into this budget over the last month. It is expected that growth will be revised up. We've been seeing that through the economic data. That should not surprise. And actually, although there is going to be elements here to try and get people back into the workforce, that's so important for the UK. If the Chancellor wants to grow the economy, he can't do it when the workforce is so stagnant. So he needs to get people back into work. He needs to announce elements for investment. But some of that good news is already in the price of sterling.
I was going to say, and I loved your note this morning, sterling back from the brink. What are some of the policies needed? I don't know whether it's investment that needs to increase significantly for support in sterling.
I think ultimately, that the whole lineup of fundamentals. So we need more growth, we need more investment, we need more productivity. All of these things, of course, all tightly interlinked, and they ultimately, will bring about, a change in psychology. But interlinked with that, we need more trade. We need more signs of it. Perhaps a softer tone in terms of the start of a trade deal with the US. That would really be helpful. We've got Biden apparently coming over to Northern Ireland and to Ireland to celebrate the anniversary of the Good Friday Agreement. Hopefully, we might see a softening in relations there, as we've seen between Sunak and the EU too. All of that, a little bit of positive news.
Jane, talking about the EU, so tomorrow we have ECB. I mean, the timing, on Monday we thought that's really unlucky given everything that's happening in banks. But does it change their trajectory? I mean, they've not only telegraphed 50 basis point hike, they've kind of committed to it.
They have committed to it, but they've also said that they don't see that much systematic risk, or they were saying this at the start of the week, systematic risk into the European banking sector. And our strategists here would maintain that view too. So I think 50 basis points, I think if they were to falter on that, they may have a credibility issue on their hands. And now that the market appears to have calmed, well, I think that just strengthens the notion that they will go with 50 basis points. Again, Europe still has an inflationary problem, so it is quite likely that Lagarde will remain, pretty hawkish. But then again, even in Europe, we are moving towards that terminal rate. And as I said, that Swedish data today, that won't be a comfortable hearing, for the Eurozone either.
Jane, as always, thank you so much for your great insights. Jane Foley, Head of FX Strategy at Rabobank. Now, we'll have plenty more, of course, on the currencies. UK Chancellor Jeremy Hunt set to deliver his spring budget later today. We'll have a full roundup, and we'll have a full special show on this where he's pledging to unlock billions in investments to boost a sluggish economy. Now, for more from Westminster, we're joined by Lizzie Burden, our Bloomberg UK correspondent. So, Lizzie, what exactly are you expecting from the Chancellor?
Well, Francine, the pressure's on the Chancellor to cash in the dullness dividend and not just steady the ship, but point it in a firm direction. We're expecting today for him to frame this budget around Rishi Sunak's top 3 economic priorities: halving inflation, growing the economy, and reducing the national debt. So on the first, we're expecting him to cushion the blow from the cost of living crisis by, as we've already had confirmed this morning, extending the energy price guarantee to reduce household bills. Also, a freezing of fuel duty, and then tackling the labour market inactivity issue, which of course is adding upward pressure to inflation, an extension of childcare provision front and centre in this budget, but also more giveaways on pensions and extending benefits, how long you can keep them if you're long-term sick but you get a job. Then there'll be some sweeteners for business, because of course we've got this planned rise in corporation tax in April, so offsetting that. And this really will be presented as a budget for growth. But the question is, how ambitious will it be when the Office for Budget Responsibility says he's not got a lot of room for giveaways, and we know what happened in markets when Liz Truss promised unfunded tax cuts.
Yeah, so we'll see reaction to sterling, although Jane Foley expects a lot of that to already be priced in. Lizzie, thank you so much. Lizzie Burden there in Westminster. Now, later today, we'll have extended coverage of the UK budget announcement. That's special, live for UK viewers from 12:15 p.m. right here on Bloomberg TV. Now, coming up, BMW upbeat on its outlook, saying China and the US could be areas for growth. We hear from the chief executive, Oliver Zipse. That's coming up next, and this is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
BMW shares are trading higher after the company said it expects 2023 profit margins around last year's level between 8 to 10%. Now, the automaker predicts the uptake in expensive vehicle sales to offset weaker pricing in entry-level models. Bloomberg's Ollie Crook spoke to the chief executive about demand in the coming period.
Our order books are very high still. We had high demand last year. There was not enough capability in the overall industry to satisfy that demand, and our order books are still full. And I think that will carry us through the next couple of months. So I wouldn't be too worried about the next couple of months. But then let's see how the world goes. The world stays volatile, but we foresee that there will be overall at the end of the year there will be some growth.
And then in terms of, so we know the categories of growth, those are a lot of that is going to be EVs, a lot of that is going to be the premium side of thing. I'm curious about geographically, where do you see growth being the big driver geographically for BMW?
We have three large regions. That's Europe, of course. We will have to see how Europe develops. Then we have the United States, where our biggest plant is located at. And we also see with the product momentum we have there are possibilities also in the American market. In China, which is our biggest market overall, we see more positively towards the latter part of the year. The whole market had a slow start, but there's a new government coming in. Customers are coming back from COVID restrictions. So we see more positively for China, but also in addition in the rest of Asia. We're more positive about that outlook.
And then in terms of EVs, you say high double-digit percentage growth. That's higher volume in EVs. I'm curious about margins. When do you think that EVs will achieve some of the similar margins that you see on internal combustion engines for BMW?
Well, first of all, we are not unhappy at all about the current margins in the EV business. We have a lot of cars also in the upper market segment, and I think this year, 15% share of our complete volume with positive margins is already possible this year. We don't sell cars with a negative margins, and step by step with higher volume growth and higher economies of scale, I think we are quite positive about also the contribution margin of these cars.
Well, that was the BMW Chief Executive Officer, Oliver Zipse, speaking to our very own Oliver Crook. Coming up later today, we'll have extended coverage of the UK budget announcement. That's special live for UK viewers, 12:15 p.m. right here on Bloomberg TV. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today. it important to you to have women in business? Are you trying to be a role model? And have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table, and in business particularly, because most consumers are women also.
On the one hand, I don't believe that SVB by itself was a systemic risk to the system. On the other hand, there was clearly contagion going on, and I think the regulators needed to provide some reassurance to the market, and they've done that with the facility. I mean, this is all about faith and trust.
State Street Chief Executive Officer and Chairman Ron O'Hanley, they're speaking exclusively to Bloomberg. Now let's get straight to the Bloomberg Business Flash. Here's Samuel Etienne. Hi, Etienne.
Morning, Francine. Meta is planning to cut 10,000 jobs and close 5,000 open roles in its second round of major layoffs. The Facebook parent already laid off 11,000 workers in November, or around 13% of its staff, as the company bids to become more efficient and improve its financial performance. Meanwhile, sources tell Bloomberg that Apple will make bonus payouts less frequently for some of its employees. The world's most valuable company is also limiting hiring for more jobs and closely watching travel spending. And Bloomberg has been told HSBC is cutting the base pay it offers newly promoted senior investment bankers by a quarter. Sources say some new managing directors are now offering, or rather offered, a salary of about £225,000. That compares with $300,000 for those already in the same position. It comes ahead of a UK proposal to lift caps on banker bonuses, a policy imposed when it was part of the EU. And Bloomberg has learned that TikTok is mulling a split from Chinese parent company ByteDance to address concerns about US national security risks. The move, which could result in a sale or IPO, is considered a last resort and would need approval from Beijing. This as ByteDance achieved a valuation of about $220 billion in an investment by Abu Dhabi firm G42, much less than the $300 billion set during a recent share buyback program. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Sam Etienne, thank you so much. Now, let's also check in on some of the stocks on the move at the open. So we start with BMW. Our Ollie Crook brought us that great interview with the chief executive officer saying they expect 2023 profit margins around last year's level as sales of its most expensive vehicles like the 7 Series offset weaker pricing for entry-level luxury models. The stock gains 0.6%. Inditex store efficiency is driving some of the fuel for record cash and profit. A big concern, I guess, about profitability going forward. 2.6% down for Inditex, and H&M actually 6% lower. It's unclear if some of the resale programs are leading firms to make fewer goods. Coming up, we'll be speaking with the Investec Bank economist Sandra Horsfield about the upcoming ECB and Fed rate decisions, as well as budget day here in the UK. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years. Or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Traders, again, expect the Fed to raise rates next week, with the two-year yields retracing over a third of Monday's plunge. The Fed is said to weigh tighter regulations for mid-sized banks following the collapse of three lenders in a week. Plus, the Chancellor, Jeremy Hunt, will pledge to drive growth by unlocking business investment in his first UK budget. His speech will be set against a backdrop of mass worker strikes in the UK today. Now, this is the picture overall for the market. So first of all, actually, the two-year Treasury yield is climbing. The focus, of course, is on short-end Treasury yields, but actually the short end of a lot of fixed income in general. We should also spend maybe a little bit of time of looking at what's happening in Europe. But equities, you can see a bit of down pressure with the Stocks Europe 600 down 0.5%. The picture overall, though, is a little bit of optimism that we're over the worst, certainly in terms of the turmoil that we saw with the banks over the last 2 days. The thing is, it's all about the Fed now. So this is next week. We have the UK budget today, and then we have the ECB tomorrow. Swaps are now pricing back, positioning for the Fed to lift rates by a 0.25 percentage point next week. The odds, actually, of an increase had slipped to nearly 50-50 on Monday. So this is a picture for whatever we're looking at, which is treasuries, which is, of course, some of the other commodities, and which is FX and equities. Utilities, telecoms, and healthcare, when it comes to equities, are the only industry groups that are seeing gains today, between 0.2 and 0.5%. And then we are seeing pressure on retail, energy, and basic resources. Amongst retail, some are top movers. Actually, on the downside was, of course, H&M, and a little bit of pressure also on Inditex. Now, the Silicon Valley bank collapse presents central banks now with a big headache, complicating the ECB and the Fed's fight against inflation. We're now joined by Sandra Horsfield, Investec bank economist. Sandra, thank you for joining us. When you look at the SVB fallout, I don't know what that means for you going forward, because if the Fed doesn't go maybe as aggressively as planned, it means that they could see something ugly in the banking sector.
Yes, it's correct that certainly financial stability considerations have now come to the fore again, and that is something that central banks will have to take into account. They don't want to break something unnecessarily, and clearly the risk of breaking something has increased, as we have seen in the market reaction that we had since. At the same time, for now, markets have calmed down, so hopefully the measures that have been put in place have been enough to contain the immediate fallout, at least.
So, Sandra, what does this mean? I mean, the Fed probably needs to talk, or, to walk a very tightrope between Silicon Valley Bank and inflation. How does it do that elegantly?
That will, of course, depend very much on what happens going forward. It's the risk of sort of not spooking markets too much, because, of course, it is the very fast pace of tightening that caused some of the issues in the first place, simply by pushing up the increase in interest rates. We've had the value of bonds on companies' books declining, and that was one of the underlying causes of the issues in crystallizing these losses. Now, what does that mean going forward? How is this to be handled? Certainly with very careful monitoring and very careful balancing of objectives. The Fed won't want to go too far. It probably will be more careful in its language going forward. And that's a sort of picture that will have to be maintained. We are now in restrictive territory for interest rates, and restrictive territory doesn't have to become ultra restrictive if other considerations come into play as well.
Sandra, is it more tricky for the Fed to toe that line because Silicon Valley Bank, of course, happened in the US, or the ECB, which is tomorrow, so unlucky in timing, but also they pre-committed to 50 basis points?
I think the issue of pre-committing and the dangers of this have really come quite clear as a result of what has happened. Right now, with markets having calmed down, we expect that the ECB will be able to maintain its commitment and indeed hike by 50 basis points as planned. What happens afterwards is perhaps more questionable, and something where perhaps the data dependency and stressing data dependency is likely to be very much on the forefront of the messaging that we'll get from the ECB. The Fed may do something similar and point out that the situation is fluid, but certainly for the ECB, data dependency had been something they had emphasized a lot beforehand and likely to do so even more going forward.
Sandra, big day for the UK, budget day and massive strikes. What are you expecting from the Chancellor?
Well, the Chancellor is in a better position than he expected to be at this point. And so we have already had news this morning that indeed the energy price guarantee will be extended for the quarter. It's less expensive than it had looked beforehand, and has the advantage of bringing inflation down slightly earlier than previously thought, by 1 percentage point more than beforehand. So that's good news. There's also said to be more help for childcare that has been pre-announced. But by and large, it's all relatively small, be it that big tax cuts that some had been hoping for clearly aren't going to be coming right now. Fiscal headroom is limited by less buoyant economic growth and less growth potential, and that's likely to hold things back. Perhaps come the autumn, that could change, but for the time being, there isn't the scope to deliver what some had hoped for by way of tax cuts.
Yeah, and this, Sandra, actually you argue very well and very articulately in your note, is that this may also take years for him to be able to do this, or whoever the next Chancellor is.
Yes, it will certainly be a complicated situation for some time. Enhancing growth potential in the UK has been a difficult situation. We've had attempts through the investment super deduction to try and boost investment. Well, so far, it's hard to tell how much weaker it would have been without it. But certainly, we're not in a situation where we're in buoyant investment growth. And without that capital, and with limited labor supply coming on board as well, it's hard to achieve the sort of growth rates that we have going forward. The OBR's assumption had been quite optimistic. We think they thought that perhaps you could get to 1.5% potential growth going forward from 2025. That may have to be scaled back. So the headroom for fiscal measures going forward may be quite constrained as well. Of course, measures such as childcare, help, etc., are aimed at enhancing that growth potential to get more people back into labor. Yeah. So we shall see whether that's bears fruit.
Yeah, and of course it's almost a vicious circle. So you get part of the population back to work if you have affordable childcare, and it helps towards, of course, the jam log of not being able to have enough workers. Talk to me a little bit, Sandra, about whether they're going to tell businesses to do more on energy bills.
I think energy bills have, of course, been the key driver of inflation directly and indirectly over the past year or so. And that's something that's very much on people's minds. Now, with the fall that we've seen in wholesale prices, the government can afford to be a little bit more generous. And indeed, that's why we have managed to extend energy support to households. On the company side, it is, of course, the case that the government had already introduced help to businesses with energy bills a bit later when wholesale prices had fallen. They announced in January that there would be a further year of support to businesses. How much more we'll get this time around is less clear. And of course, much will depend on energy prices actually maintaining the sort of lower levels that we've had recently. So far, the picture is good, and that's very helpful to the economy, to a country such as the UK, which is a net energy importer. But of course, the jury is still out as to what will happen further down the line when it comes to next winter. And the weather is, of course, a variable that we can't control and we don't know, but has a big bearing on the outturns.
Yeah, so many question marks. Sandra, thank you so much for helping us understand this a little bit better. Sandra Horsfield, Investec Bank economist. Coming up, we'll be speaking with the shadow chief secretary to the UK Treasury, Pat McFadden, ahead of the budget. That interview is next from Westminster. This is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, Marcus today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 41 minutes into the European trading day, so we're very far away from the panic that we saw Monday and also Tuesday onto the banks, but we're still seeing a little bit of pressure as markets trying to wade through what this means for the Fed, how many hikes we get, if we get, and then looking forward to the UK budget a little bit later today. A bit of pressure across European stocks. Now let's get straight to the Bloomberg First Word News with Samuel Etienne. Hi, Etienne.
Hi, Francine. The Fed is said to be considering changes to its oversight of mid-sized banks following the collapse of free lenders over the past week. Regulators at the U.S. Central Bank are weighing bringing capital and liquidity thresholds closer to those that apply to big Wall Street firms. The changes would affect banks with assets between $100 billion and $250 billion. The head of one of the world's largest asset managers called Moody's outlook cut for the U.S. banking system a terrible overreaction. Speaking to Bloomberg exclusively, State Street CEO and Chairman Ron O'Hanley said the regulators had reassured the market following the collapse of three lenders.
We don't want any confrontation between the United States and the Russian Federation. We are in favor of pragmatic relations for the interest of the people of the United States and the Russian Federation.
The Pentagon says a Russian fighter jet collided with a US surveillance drone in international airspace, causing the craft to crash above the Black Sea. Russia's defense ministry denied the claims, saying the jets did not come into contact with the drone. The State Department says the collision was, quote, a brazen violation of international law. Meanwhile, the Russian ambassador to the US, Anatoly Anatov, sought to diffuse the tension. That's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Etienne, thank you so much. Samuel Etienne in London. Now, it's budget day in the UK, in case you hadn't noticed. So Chancellor Jeremy Hunt has pledged to drive economic growth by unblocking business investment. But the day will also be marked by ongoing industrial disputes. Now, around 500,000 workers across the country will take strike action over pay and the rising cost of living. So for more on all of this, let's get straight to our Bloomberg UK correspondent, Lizzie Burden, who's standing by with a guest at Westminster. Hi, Lizzie.
Hi, Francine. Thank you. I'm on the green in Westminster with Pat McFadden, Shadow Chief Secretary to the Treasury. Pat, thanks for coming back on Bloomberg TV. A lot of this budget has been leaked. We're expecting the rabbit out of the hat to be an extension of childcare provision. They've stolen your sandwiches, haven't they?
The rabbit may be already out of the hat. I mean, I remember the days when you couldn't leak budgets and chancellors would be fired. Famously, a Labour chancellor resigned voluntarily back in the 1940s for a very small part of the budget coming out in advance. But it's very different these days. A lot of things come out, specifically with regard to childcare. I'll be pleased if the government takes some action on this. We've been calling for this for some time because it's so expensive for people. And in Britain, people are paying a bigger proportion of their income in this than in many other countries. And it's become a barrier to parents, usually mums, returning to work after having children. So we'll look at the detail, but if they're taking action on it, I'll say it's a good thing that that's happening. And I'm glad that Labour set the agenda and pressured them into doing it.
I'm trying to work out where the points of difference are between Labour and the government. Of course, you're the opposition. You're also pitching yourselves as the party of business. Yes or no? Would you cancel the planned rise in corporation tax?
No, and when we talk to businesses, the headline rate of corporation tax is not really the main thing that's raised with us. There are other things business is concerned with. They are concerned with workforce that we've just spoken about and supply of labour. They're concerned with investment allowances, and we'll be looking closely at what the Chancellor says about that today. Not only the policy, but how long is it going to last for? Because they chop and change far too much. They're still concerned with the post-Brexit trading environment and the difficulties that Boris Johnson's deal has given people, and they're concerned with planning and delivery. So there are lots of things that business is concerned with when it comes to growth. And to be honest, in my discussions, and I think it's true of my Labour colleagues too, the headline rate of corporation tax is not usually among the top few things that people raise.
Well, the CBI is calling for a permanent extension of the super deduction on capital investment. Would you do that? Well,
certainly whatever we did, we tried to make it long term. I think that's almost as important as the content of the policy. We think investment allowances is a better way to encourage investment than constantly chopping and changing with the headline rate of corporation tax. But even if you settle on a system, try to keep it in place for more than a year or two. That's what my colleague Rachel Reeves, the Shadow Chancellor, called for in a speech leading up to the budget last week, and that's what we want to see.
And thinking about the Silicon Valley Bank UK crisis over the weekend, would you have handled that any differently? Would you have any concerns about HSBC being the buyer?
In the immediate sense, I think it was absolutely right to find a buyer over the weekend. And I congratulate all the officials and the Bank of England and everybody who was involved in that. But I don't think the story ends there, because I think that the fact that the bank was so vulnerable should raise questions for the regulator. Are there other unexploded bombs, as it were, elsewhere in the financial system? You'll remember it's only a few months since the LDI crisis, when the bank had to step in following the disastrous Conservative mini-budget back in the autumn. That should have raised some red flags as well about parts of the financial system. So I hope that they're not just breathing a sigh of relief and saying, well, we solved the Silicon Valley Bank issue, we don't need to do any more, because the last thing you want in a situation like this is contagion.
And you mentioned that you would want to take a longer-term approach to matters of fiscal. You've said that you would close the non-dom loopholes, raise windfall taxes. It's really a drop in the ocean compared to all the ambitions that the party has. How would you, which other taxes would you raise? What other cuts would you make?
The choices you make say quite a lot about you, I think, and it's interesting that while the Conservatives are adopting some of the suggestions that we made in the run-up to the budget, for example, the extension of the price cap for another few months, which was scheduled to go up £500, they're not funding it through means that we've suggested, which suggests it's all going on either more borrowing or the general taxpayer. So we think that policies like getting rid of the non-dom tax break and making sure that the windfall tax applies properly and that some of the loopholes in it are not applied could actually do these things in a more equitable way. So it's not just about what you do, it's about how you fund it too.
Pat McFadden, Shadow Chief Secretary to the Treasury, thanks so much for being with us. Francine, I think we'll be playing bingo later to see how many times they mentioned Silicon Valley in this budget. We know that Rishi Sunak used to like to say he wanted Britain to be the new Silicon Valley, but after this weekend we'll have to see.
Yeah, it's game theory all over again. Lizzie, thank you so much. Lizzie Burden there with the very latest from Westminster. Coming up, U.S. tech firms continuing their cost-cutting with Meta to slash 10,000 jobs. So we'll have plenty more on that story next. And this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open, everyone. 52 minutes into European trading day. We're seeing a bit more losses than we did half an hour ago. The Stocks Europe 600 down 0.6%. I would also point to the fact that the short end Treasury yields rising for a second day. U.S. equity futures pretty much steady. Again, I guess concerns over the U.S. banking system the sector has eased while rising inflation has also supported bets for further Federal Reserve hikes. Now, we are also getting some breaking news from Credit Suisse. Yesterday, we had a conversation with the chief executive. Now, their top shareholder at Credit Suisse has ruled out more assistance to the bank. We were at pains to trying to figure out from the chief executive yesterday if they were going to ask their main investor. This is, of course, a Saudi bank for more money. He said there was no need, and now we heard it from the other side, the top shareholder ruling out more assistance to the bank. Now, onto technology stocks. Meta planning to cut 10,000 jobs as part of its second major round of layoffs. Joining us now from Berlin is Bloomberg's Berlin-based tech reporter, Aggie Cantrell. Aggie, good morning. So first of all, why is Meta planning further cuts?
So, Francine, this is really a continuation of Zuckerberg's commitment to what he has called the year of efficiency. We heard that back at an investor call in February. We heard that was being communicated to Meta employees during their own performance reviews last month. And now we're hearing it again. That's how he introduced these latest round of 10,000 job cuts at the company. This is all about cost cutting, all about keeping costs under control at a time where we're seeing a lot of tech companies weather a storm of higher interest rates that are having an impact also on consumer sentiment, and they're worried about ad revenue going forward.
So, Andy, what's the situation for the broader tech industry?
Yes, so the thing with Meta is that it is quite a dramatic amount of people. This is 10,000 on top of the thousands that were already announced earlier this year. But what we're seeing is essentially Meta has committed to these cost cutting, but they're not alone. A lot of the tech sector, a lot of the big players in Silicon Valley are really scrutinizing their costs. We also heard that Apple is currently considering delaying the bonuses for some of its employees. And this is part of a broader concern for the tech sector. As Mark Zuckerberg put it yesterday, the sector is essentially expecting a tougher time for potentially years ahead.
Aggie, thank you so much. Aggie Cantrell there with the very latest on some of these tech stocks. Now, this is another Bloomberg exclusive. I think our reporters on the ground have just been speaking to the Saudi National Bank chairman, Mr. Al Qudayri. They are, of course, the biggest shareholder in Credit Suisse, and they have just ruled out more assistance to the bank. So if we get the share price up, it's down 3.7%. We understand that the S&B chief has said that they will absolutely not provide more assistance to Credit Suisse. And they have cited regulatory issues on Credit Suisse. So watch out for that. The worrying signs is not only we look at the credit default swaps, but if you look at the cost of insuring right now, the bonds of Credit Suisse against default in the near term, they're actually approaching 1,000 basis points. That's a level that typically signals serious investor concern. So let's check in on some of the other stocks that are on the move. BMW expects 2023 profit margins around last year's level as sales of its most expensive vehicles actually offset weaker pricing for entry-level luxury models. So you can see BMW gaining 0.5%, Inditex down 3%, reporting record earnings and cash, but concerns maybe about inventory going forward. And then there are also concerns about H&M, unclear if the resale programs have led the firms to make fewer goods. That's it for the Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
An effort to push down some of the regulation that currently applies to larger banks down into the smaller banks. I myself think that for the most part, that will probably be a mistake.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 5 a.m. in New York, 9 a.m. in London, and 5 p.m. in Hong Kong. Our top stories today. A pleasant surprise for Bank of America. The firm raked in more than $15 billion in new deposits in a matter of just days, emerging as one of the big winners after SVB's collapse. The Federal Reserve is considering changes to its oversight of mid-sized banks, stress tests, capital and liquidity structures, all under review. Plus, in the UK, Chancellor Jeremy Hunt will pledge to drive growth by unlocking business investments in his first UK budget. His speech will be set against a backdrop of mass worker strikes today. Welcome to Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in Paris today. Matt Miller is off now. Anna, I'm here in New York. Not a ton happening in terms of excitement in the city, but you're in Paris. What takes you to Paris?
What takes me to Paris is the Bloomberg New Voices program, so an effort by Bloomberg to increase the range of voices that speak to Bloomberg TV. Kriti, so watch this space. New voices coming shortly to Bloomberg Television. In the meantime, back to the markets.
Yeah, back to the markets. I mean, I'm a little jealous of that assignment, Anna. I have to admit, I want to go to Paris. I've never been. I really should go visit. But meanwhile, stateside here in the markets, we aren't seeing a ton of conviction in either direction. In fact, futures are only down about 0.2%, a little bit weakness in the equity market. But I got to say, I think that's a theme we might just be seeing worldwide. Stay tuned. Anna's going to walk you through the European action in a second. For me, it's all about the bond market. The two-year yield kind of grew, rising once again. Remember, it retreated pretty heavily back from that 5% level. We're now at 4.33, a move already overnight by about 8 basis points stateside. And that, of course, taking with it some dollar strength. One of the biggest contributors to that dollar move higher is the Japanese yen. We're looking at a 134 handle for that currency pair. Certainly something you want to watch, even though the Nikkei itself overnight really unchanged. So some interesting dynamics happening over in Asia, not necessarily bleeding into the pre-market U.S. session. Bitcoin, though, we have to keep an eye on it as crypto becomes a big part of not just the SVB collapse, but perhaps the Signature Bank collapse as well stateside. To what extent does that is included in the regulation review? Nevertheless, it doesn't seem to be stopping investors from piling in. Bitcoin shares, Anna, or Bitcoin, I should say, in general, higher by 1%. What's going on in Europe?
Yeah, let me tell you what's going on in Europe. Here in Paris and elsewhere in Europe, we see weakness across European equity markets. The stock 600 down by around 0.8%. So what seemed to be some line in the sand, maybe a little bit of resilience in the market psyche at the start of the trading day, has quickly deteriorated. The CAC 40 here in Paris down by 1%. The Xetra DAX down by 0.5%. Elsewhere, the IBEX and the FTSE MIB down by more than 1.5%. We continue to see weakness as a result of concerns perhaps around SVB, concerns perhaps around the banking sector in Europe. And let me get to that right now for you. Credit Suisse, you can see down on the board there, down by 5.3%. Top shareholder, this is the Saudi National Bank, top shareholder in Credit Suisse has ruled out more assistance to the bank. As a result of that, we are seeing some weakness in the share price as we speak. So that one moving as a result of those news signs. We'll get a further update from Saudi Arabia, where Bloomberg TV has been speaking to that bank shortly. We've also got the German 2-year yield in there, just showing you the bounce back that we're seeing in yields. And we're seeing that across various geographies here in Europe. We're seeing it in Italy, in France, in Germany. And perhaps that is also something that is weighing on sentiment, along with the banking story. Also weighing on sentiment is news out of the likes of H&M in the retail space. We've got a disappointing, described by some analysts as disappointing today, update from H&M. Bolloré, I put this in here just because it's the biggest gainer on the stock 600, and it is French, and I'm here in Paris. A diversified business across a whole host of industries, including media. A tender offer for nearly 10% of that stock, and so as a result, the best performer today. And the Brent price, worth mentioning, up by 1%. We got news lines at the top of the hour from the IEA saying that the energy market is now in surplus. Russia pumping more crude, and as a result, in surplus. We will get, we've seen though, before that news hit, we'd seen resilience in the oil price, and we continue to see that as a result of the Chinese data, which showed a recovery from some of the COVID period, of course, Chrissy, so that's certainly in focus.
Yeah, certainly in focus, alongside, of course, all of the moves and the continued fallout, or perhaps continued success for a lot of banks following the collapse of SVB and some others. Bank of America, for example, mopping up more than $15 billion in new deposits, and it just took a couple of days. The Wall Street giant has emerged as one of the big winners after the collapse of 3 smaller banks, denting confidence in the safety of regional lenders. Valerie Teitel, Bloomberg Markets reporter, joins us now. Valerie, $15 billion. That is no small amount to scoff at.
$15 billion, Critty, in a matter of days. The big question for the markets and for the banking sector going forward is just what, to the extent this deposit flight from the regional banks into the too big to fail banks, what extent will that continue? And how will we know about it? Bank of America was the first one to throw out a big number, $15 billion, but we have yet to hear from the likes of JP Morgan, Citi, Wells Fargo, just how much have they raked in. We do get a weekly number from the Fed in terms of commercial bank deposits. It's broken out into the top 25 large institutions versus the smaller institutions in the banking sector in the U.S. We get this updated data next week. Will it show a huge shift? And in the weeks and months to come, will that trend continue? That is the big question for regional banks. Their business model is coming under a lot of pressure from these deposit flows, but they're also competing with money market funds, which are returning a juicy 4%.
Yeah, so if we're seeing some money coming out of, or going into the big banks rather, and coming out of some of these regional banks, this deposit flight, as we maybe describe it, at least in part, Valerie, what does that point to? Does that point to a larger take-up of the Fed's new lending facility? How do we work all that in?
Anna, it possibly could, especially if this trend continues and these regional banks continue to lend on, continue to lean on this new lending facility. Now, remember, this lending facility had some pretty generous terms. There was no haircut on collateral, and these regional banks could mark those securities at par when they repo them versus the Fed. We get updated data on the Fed's balance sheet tomorrow evening. The big question is just how many months of QT could this lending program undo? A lot of people were very confused about the rally in equity markets yesterday, but maybe it's because they are reassessing the new lending facility, seeing it as a QE trade. And we know that QE has buoyed equity prices over the last year, and perhaps the market is just reassessing what this lending facility could mean for risk assets.
Bloomberg's Valerie Teitel walking us through a pretty complicated issue in the markets. We thank you as always. Meanwhile, the Fed said to be considering changes to its oversight of mid-sized banks following the collapse of those three lenders over the past week. Regulators at the U.S. Central Bank weighing bringing capital and liquidity thresholds closer to those that apply to the big Wall Street firms. Randy Quarles, former Fed Vice Chair for Supervision, playing down the role of those looser rules in Silicon Valley Bank's collapse. Take a listen.
I think there will be an effort to push down some of the regulation that currently applies to larger banks down into the smaller banks. I myself think that for the most part, that will probably be a mistake driven by a misunderstanding of what just happened. I think there are interesting questions about how to improve regulation in light of what happened, a lot of which have to do with the treatment of uninsured deposits.
Michael Moore, Bloomberg Finance Editor, joins us now for more. Michael, a lot to digest here. Things happening very quickly on the regulatory front, which is almost a highlight in itself. Are we essentially expecting some sort of Dodd-Frank 2.0?
Well, I think it would be more of applying Dodd-Frank to more banks, and the stricter elements of that. Right now, there's kind of 4 categories of banks within the Dodd-Frank regulations. And, category 1 are the names that we know and are the ones that have the most attention. But if you look at the stress test last year that were published by the Fed, it had 34 banks in it. Will we see that number go up as smaller banks get added in there? SVB was not subject to the liquidity coverage ratio that other banks have to do that says you have to hold enough liquidity to cover a month of outflows based on your best guess of what that could look like in a stress period. SVB, because it didn't have much wholesale funding, because it was mostly deposits, wasn't subject to that. But are the regulators going to reassess that now that we've seen that deposits are perhaps not as sticky, especially when they're uninsured and from a concentrated base?
Yes, absolutely. A lot of reasons perhaps to revisit those rules, as we were hearing. Michael, in amongst all of this turmoil in the banking sector, we're also hearing about strategies around pay, in particular from HSBC, or reporting tells us this. What do we know?
Yeah, so what we're reporting today is that many people that were just promoted to managing director, so the highest rank at HSBC, got a smaller salary than what's typically been given to that level. And I think what you're seeing here, as the UK removes the bonus cap, some of the banks are using that to lower salaries or reduce the salary growth to try to adjust to that and move to a model like we've seen in the US, where salaries are a little bit lower, but more of the comp is in bonus. So we'll see if other banks follow suit, but this was definitely something that we've been wondering since last fall, when the UK moved in that direction to get rid of the bonus cap that is in place in the EU. Were you going to see that mix change? And I think we're starting to see that sign.
Okay, thank you very much. Thanks to Michael Moore, Bloomberg's Michael Moore, with the latest on some things in the banking sector. Sticking with banking, in fact, Credit Suisse's top shareholder has ruled out providing more financial assistance to the struggling Swiss bank, citing regulatory issues. Bloomberg's Yusuf Gamal El-Din joins us now with more. And Yusuf, I see that the share price of Credit Suisse actually touching a record low as a result of this, and these news lines that you bring us, down by 6% in session today. Yusuf.
Yeah, Anna, so I caught up with the chairman of Saudi National Bank, and his tone on Credit Suisse specifically, far from the optimism and confidence when we broke the first interview back in late October into early November of last year. The thing to remember here is that they're seeing these regulatory obstacles that are going to keep any participation on their part quite limited. But there was clearly also no interest to go beyond into any other creative ways to support. I asked about the franchise, Credit Suisse First Boston. He says, no, we're not going to take part in that either. And some of the other conversations I've had here on the sidelines suggest that there's a growing sense of frustration that despite a lot of the regional support and very much being front and center as part of the Credit Suisse overall into late last year, there is disappointment and a sense that, you know, we've done our part and the rest is up to Credit Suisse. Take a quick listen here in terms of what he had to say.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
I mean, you have a clear answer there. The credit default swaps have blown up. The stock is flirting with 2 Swiss francs a share. It's down 25% in the span of a month. And for Saudi National Bank, this is still quite a small, you know, a small exposure. So it's not a concern for the bank as a whole, but it's no longer an interesting play, even though they were touting some integration benefits to the Saudi growth story, guys.
Bloomberg's Yusuf Gamal El-Din with some breaking news really moving the markets there. We thank you, as always, for that context. Meanwhile, we should probably stick with what's going on in the Middle East at the moment. Abu Dhabi firm G42 valuing ByteDance at around $220 billion, much less than the $300 billion set during a recent share buyback program. Joining us now is Madison Mills in Dubai. Maddie, how significant is this change in valuation? Walk us through Abu Dhabi's involvement here.
Yeah, Kriti, so going from $220 billion, like you said, we have to look at the context here, right? The peak valuation for TikTok came in 2021. That number was $460 billion. The latest valuation coming in at $300 billion when it set its own share buyback program. So this $220 billion valuation coming as a bit of a big discount when it comes to the ByteDance deal here. Now, looking at the reasoning behind the jitteriness in that valuation, we think of regulatory concerns, right? In the United States, as you know, there are a lot of questions about the security of TikTok, specifically owned by ByteDance, and what that looks like kind of remains to be seen. In terms of the Middle East, though, Abu Dhabi's G42, it's an AI firm here. This could be a sign that the Middle East is willing to bet on China's economy rebounding. This is a $100 million purchase of these shares in a private market purchase. And this comes from a firm that is known for being on the forefront of these tech innovations. So could be a bet on China booming moving forward.
Okay. Okay, if this is a bet on China, Madison, then it raises the question of just how Chinese TikTok is. And this comes as TikTok has said, or has considered, splitting off from ByteDance if US regulators don't approve the company's existing security proposals. What do we know here?
Yeah, so that split would only be a last resort, according to TikTok. But we know from our Bloomberg reporting here that those regulatory concerns have pushed TikTok to create this Project Texas plan that really pushes an implementation of a number of changes, including one of those changes being Oracle hosting U.S. user data and reviewing its software, a big internal review and external review as national security officials look into the security of TikTok. Whether or not that deal gets done and U.S. officials are okay with those changes is the big question for TikTok. They say that if that deal gets shot down and officials aren't happy with it, then they are potentially going to move forward with a divestiture. And if they do that, our analysts say a sale or IPO could be valued anywhere from $40 to $50 billion. And maybe the likes of Microsoft would be interested, particularly if that Activision deal falls through.
Madison, thank you very much. Bloomberg Quick Take reporter Madison Mills there with the latest on a few tech themes, well, both involving TikTok, in fact. Coming up on this program, the monthly oil report is out from the IEA. We will speak to Toro Bossoni, the IEA's head of oil markets. The report this morning saying that the market is in surplus as Russia pumps more crude. We'll dig into those headlines. We'll talk about Russia in energy markets. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in Paris today with Kriti Gupta in New York. Let's talk about oil markets. Global oil markets are contending with a surplus as Russian production defies predictions of a slump while fuel demand slowly picks up. According to the IEA's report out this morning, that's the state of the oil markets. Joining us now, Toril Bossoni, who is the IEA's head of oil markets and a great person to speak to then about a market in surplus. Toril, thank you very much for joining us. So you say this morning in your report that the market is in surplus as Russia pumps more crude. In fact, you say that inventories have surged. Do you see anything that changes that? Do we remain in surplus for a period?
Good morning. Yes, no, we're starting off the year in relative comfort. As you know, Russia production has been holding up very close to pre-war levels. The price cap that has been put in place has allowed the Russian oil to divert to new buyers in Asia mostly, as it getting back out of Europe. But we're also seeing that demand already in the fourth quarter of last year declined year on year, and we're starting with weak demand at the start of 2023. So looking forward, we're expecting a sharp recovery in oil demand this year. From the first quarter to the fourth quarter of 2023, we're expecting an increase of more than 3 million barrels a day increase in oil demand as China economy opens up after COVID restrictions are lifted. Jet fuel continues to recover after the COVID slump. And that increase will be difficult or be challenging to meet. So we could very quickly see the market shifting back to deficits as the year progresses.
Okay, so we're in surplus right now, as you described, but there is demand coming back quickly, Toril, so things could get more difficult later in the year. You mentioned Russian supply in your report, and I wanted to ask a detailed question about Russia. We see a big spread between the price of Russian oil when it's exported and the price when it's imported. I wonder if you have a sense of where that money is going, and are you confident that that money isn't ultimately returning to Russia? Are we saying here that there's a freight and logistics bill of around $20 a barrel, which is the difference perhaps here? Where do you think that money is going?
Well, that's a good question. This is something that we looked into in detail. Of course, we're tracking very closely both the price that Russia is getting for its crude and product exports and comparing that to market prices for non-Russian grades. And we are seeing a big discount. We're also looking to see what countries are paying for their oil in terms of what they're declaring to customs, both in terms of volume and value. And it is clear that the freight rates, the shipping costs, the insurance costs have surged, and there are new buyers, there are new players emerging outside of the European Union, because as you know, maritime services provided by the EU would only be allowed to be used to transport this oil if the oil is traded under the price cap. So exactly trading companies, shipping companies, insurance companies, both Russian-linked or in new jurisdictions, but also the traditional sector are getting part of that extra revenue.
Toral, you mentioned the price cap specifically. Are there further steps to take on that front? Have they really proven as a success?
I think so. I mean, the aim of the price cap is to limit revenues that Russia receives for selling it oil, but at the same time allowing the oil to flow. As we see, Russian oil is flowing to market. In February, we saw 500,000 barrel decline in exports from Russia, but from a very high number in January, just ahead of the latest product embargo that came into effect. But what we're seeing is that the revenues, Russian export revenues in February were down almost $3 billion, 2.7, to the lowest monthly number since the start of 2021, and down more than 40% on a year ago. So I think we can say that the price cap is working. Oil continued to flow. Buyers in Africa are now picking up product exports at a cheaper price. And this was the intentions of the price cap in the first place. Now, going forward, the price cap will be reevaluated every 2 months. There is a process underway from the price cap coalition. So it'll be interesting to see if the price cap will be set lower for crude or for products as the year progresses.
Well, Toral, let's talk about another one of the global stories. Of course, in the last week or so, we have seen the collapse of Silicon Valley Bank kind of trigger collapse and concerns around the world in the financial sector. Are you seeing any sort of read-through into the oil market?
Well, we've seen oil prices come down over the past few days, and it's very much linked not only to the surplus that we're seeing in the market right now, but to the concerns about the macroeconomic environment, the financial sector, how the collapse of the SVT Bank will feed into the broader financial sector and what implication will have on economic growth going forward. This obviously will have an impact on oil demand going forward and the balances. So this is something that we're watching. The latest price moves that we've seen very much linked to the concern and not so much any physical impacts from this collapse on the oil markets, but continued concerns about the economy, interest rates, and steps that governments might put into place.
Okay, so that's something you're watching. Can I ask you about the French side of this? The French strikes, which I'm in Paris today, you're in Paris, French strikes taking place, of course. Is this going to have an impact on oil product supply? Will France need to import a lot of oil products to compensate?
Another good question. We all remember the strikes back in October when the French refining sector and distributions of products was halted for many weeks. Now, of course, there are renewed strikes in the refining and delivery of products, but I think the stockholding agencies, the governments, the retail stations are better prepared this time around. So there fuel seemed to be available at gas stations for the most part. We've seen very limited disruptions to the supplies as of yet. And now it will all depend if the strike at the refineries and distributions will step up, including more sites and how long it would last. But of course, we hope that we will avoid the situations that we had
Toral, of course, something, and we're
year.
going to have to cut you off just for time, but thank you as always for joining us. Folks, stick with us. Toral Bassoni of IEA. More coming up. Stick with us. This is Bloomberg.
we've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
From London in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A pleasant surprise for Bank of America. The firm raked in more than $15 billion in new deposits in just a matter of days, emerging as one of the big winners after the collapse of SVB. Credit Suisse's top shareholder ruled out providing more financial assistance to the struggling Swiss bank, citing regulatory issues.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
Plus, Chancellor Jeremy Hunt will pledge to drive growth by unlocking business investment in his first UK budget. His speech set against a backdrop of mass worker strikes today. I'm Kriti Gupta in New York with Anna Edwards in Paris today. Matt Miller is off. Anna, it's an exciting day around the world, but I've got to say, I think you have the best assignment maybe in Paris.
Yeah, perhaps I do. Perhaps I do. Nice to be in Paris, launching a Bloomberg initiative to try and broaden in Paris the number and variety of guests that we bring to Bloomberg TV. But thinking about the variety of guests, we just had that incredible interview with the Saudi National Bank, Chrissy, which seems to be moving share prices here in this part of the world, certainly moving the banking sector, moving the Credit Suisse share price down by 9% this hour. Certainly a story we keep under review. What else are you seeing in the broader markets?
Well, we got to see if that kind of bank fallout that you're seeing in that part of the world is really echoing into sentiment here. And Anna, I got to say, you're not seeing that same volatility that perhaps you've seen in the last couple of days off the collapse of SVB and Signature Bank here in the States as well. But take a look at futures. They are certainly worsening. You are seeing the sell-off increase or snowball a little bit, down about 0.5%. Again, this is nothing compared to the sell-off we've seen in the last couple of days, but still, you're seeing risk sentiment is perhaps not as positive. The two-year yield, though, is what catches my eye. 431 on the front end of the curve, especially as we see varying forecasts on Wall Street of what we're going to get out of the Fed next week, as high as a 50 basis point hike from the likes of Citi, Morgan Stanley, to potentially a cut of 25 basis points as Nomura came out and say, nevertheless, that's pushing yields higher by about 6 basis points on the front end. 431 on that note. And as a result, pushing the dollar higher as well. Dollar strength higher only marginally by 0.1%. That's really where you're seeing a little bit of the change in the trade, because it was much stronger just 30 minutes ago, Anna. A lot of the move coming from weakness in the Japanese Chinese yen. The Asian session relevant in the FX space today. And of course, Bitcoin higher as well, up about 0.8%. But I wonder, as we talk about risk sentiment, at what point does that catch up to the risk-off sentiment you're seeing in futures? That's the macro picture. Anna, let me get you a few pre-market movers as well. Because again, to your point, the banks are certainly in focus. Perhaps not the big ones, the smaller ones. Western Alliance is the one that catches my eye. A big rally this morning, up about 7%, after Ken Griffin Citadel reports a 5.3% stake in the regional bank. Remember, this is a bank that has sold off somewhere between 60 to 80% in the last week or so. Their price-to-book ratio is just tumbling through the floor, making it a pretty attractive buy. You also have the likes of First Republic, PacWest as well, also getting a little bit of a bid. Once again, it is an easy buy when you look at some of the technicals and some of the valuations, higher by 11 and 4% respectively. But I'm going to take one step away from the bank sector and talk about AMC for a second. AMC Entertainment investors backing a share increase and a reverse split. How's that for a blast from the past, Anna?
Yeah, absolutely. Let's get back to the European story I was mentioning with the weakness in the banking sector certainly being a feature of that, Chrissy. Let's have a look at the European equity markets. And broadly speaking, we're much weaker across these European equity markets, down by more than 1% now on main markets. So the Stock 600, the FTSE, the CAC 40, and the Xetra DAX all down by more than 1%. In particular, the French market down by more than 1.5%. Retail is one of the real areas of weakness, and that ties in with the H&M story. That's applying some weakness there. Disappointing numbers. But away from retail, the other two sectors that are weak, banking and financial services. We see the Credit Suisse share price down by 7.6%, touching new all-time lows today. It's been down by 9%. We had that interview, our colleague bringing us that with the the Saudi National Bank, the SNB over there, saying they will not be increasing their stake. As Kriti, you were just showing in those headlines, you played a clip of him saying that they're not going to increase their stake in Credit Suisse. So that is something that puts some downward pressure on the Credit Suisse share price. The Brent price is resilient in the face of these IEA lines that talk about surplus, because of course they're talking about a fast return of demand later on in the year, which could push things into a tighter oil supply situation later on in the year. But broadly speaking, we do have a pretty negative session here underway, Kriti, for European equity markets. And it seems to be the banking sector, financial services, both of those doing particularly badly this morning. The Stock 600 banking index falling by more than 2.5%, led by BNP Paribas, though I should say that the Credit Suisse share price, of course, falls in a different sector in financial services rather than in banking, and that one also under pressure, down by more than 7%.
Yeah, a lot of things to keep in mind across the board when you're looking from the oil sector to the financial sector. How do you process it all ahead of the FOMC meeting next week? Joining us now to break it all down, Klaus Bader, Societe Generale Global Chief Economist. Klaus, always a pleasure to have you on the show. Look, in the last week, we've seen a variety of calls from banks around the world, ranging from a 50 basis point hike to a 25 basis point cut, really creating some pretty interesting and historic bond volatility. Klaus, where do you stand on that spectrum?
Well, I'll be honest, we changed our mind a couple of times too, but we didn't necessarily go to press with it. But no, we think, you see, there have been actually all these problems in the banking sector, but I think we got to think about, back to first principles. And I think that interest rate policy is there to control inflation. That's how central banks certainly see it. And you influence inflation through managing and manipulating demand. And on that front, the signs are pretty clear that the economy demands, both the US and the European economy, demands more tightening, more monetary policy tightening. We've had a very strong labor market report with some edges, but in the US, but it was a strong report. We've had a stronger than expected core reading on inflation, so we think the Fed is going to move. However, with the jitters in the market, is it really a great idea for the Fed to jump by 50 basis points or to re-accelerate the pace of interest rate increases? Probably not. So we're looking for 25.
So what is or should the Federal Reserve's priority be here? Should it be price stability for American consumers and as a consequence, really the rest of the world? Or should it be financial stability right now, reinstating that confidence in the banking system and liquidity broadly? What's more important, price stability or financial stability?
Well, I think in the long term, price stability is definitely more important, and it's something that is much more closely in the remit and within the realm of the instruments that a central bank has, rather than financial stability. Now, financial stability, when it gets bad enough, of course, it impacts on the economic stability and therefore on the price outlook. But, fundamentally, we take care of banks and financial stability through regulation. And I think the Fed has done a lot, and in particular in concert with the other American authorities relating this, which is the Treasury and the FDIC. I think they've done everything to avoid a bank run, and that was really, or a wider bank run, that was really the imminent concern here for everybody. They've opened up a liquidity line to the banking sector. So I think as far as the Fed's action to stabilize the financial markets and the financial sector, they've done pretty much all they could do. And now it's time to think about their principal remit, which is price stability.
Okay, so we'll leave them to get back to price stability, perhaps. Let's see if that happens. Are you concerned that other things break here, Klaus? Have we seen what's going to break here in the global economy as rates go higher? Or are there other shoes left to drop to sort of mix those metaphors? We've seen the LDI crisis in the UK. We've seen the collapse of Silicon Valley Bank and others. Are we now looking at other crises? Some people mention real estate. Others mention leveraged loans. Where would your focus be?
Well, I think real estate is a really big issue because real estate valuations have gone up a lot through the period when central banks, were in all-out easing. So I think that's definitely a concern. I've been for quite a while concerned about private equity / venture capital, because I think to a large extent they're based on very low interest rates and very high equity valuations, and of course those aren't there anymore. So I've been worried about that sector, private equity, to be the next shoe to drop. But to quote a wonderful quote from Warren Buffett, it's only when the tide goes out that you realize who's been swimming naked. And when you do normalize monetary policy, you do raise interest rates. What invariably happens is stress points come up, and they're not exactly black swans. They're known unknowns, but they are unknowns. And so we have to be on guard in that. And at the same time, it's not an argument to keep monetary policy at levels of expansion that are just totally unsustainable, because they're just going to create more vulnerabilities. That's at least how I see it.
Okay, we'll be reaching for our bathing suits. Klaus, thank you very much. Klaus Bauder of Societe Generale, thank you very much for joining us. Very good to have you on the program. Just a quick word on Credit Suisse. We mentioned at the last time we checked in, the stock was down by nearly 9%. Well, just to reiterate the pressure it's under today, that drop extending to double digits. The Credit Suisse stock extending its drop to 10%, hitting another record low. Coming up on the program, we'll get back to other corporate news. BMW is positive on profit margins, part of our interview with the CEO of the German car maker. That's coming up next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time every weekday at 5 p.m. Eastern Time. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
I see investment decisions more and more taking place to the detriment of Europe and actually also Germany, because we have clearly lost competitiveness with the higher energy prices, and we have not delivered any compensation for that. And so for me, unless we actually save more energy and get prices down, unless we work much harder to compensate the loss of competitiveness in energy somewhere else, we will not see the investments that we need.
The CEO of the German energy giant E.ON there, speaking with Bloomberg earlier. Of course, Germany's done incredible things to reorganize its energy mix over this winter, but now the CEO saying that the German economy is at risk of deindustrialization, or at least that risk cannot be ignored. Meanwhile, sticking with Germany, we spoke with another executive of a big German household name. BMW said it expects 2023 profit margins around last year's level, between 8 and 10%. The automaker predicts the uptake in expensive vehicle sales to offset weaker pricing in entry-level models. Bloomberg's Oliver Crook spoke to the CEO about demand in the coming period. Let's listen.
Our order books are very high still. You know, we had high demand last year. There was not enough capability in the overall industry to satisfy that demand, and our order books are still full. And I think that will carry us through the next couple of months. So I wouldn't be too worried about the next couple of months. But then let's see how the world goes. The world stays volatile, but we foresee that there will be, overall, at the end of the year, there will be some growth.
And then in terms of, so we know the categories of growth, those are, a lot of that is going to be EVs, a lot of that is going to be the premium side of thing. I'm curious about geographically, where do you see growth being the big driver geographically for BMW?
We have three large regions. That's Europe, of course. We will have to see how Europe develops. Then we have the United States, where our biggest plant is located at. And we also see, with the product momentum we have there are possibilities also in the American market. In China, which is our biggest market overall, we see more positively towards the latter part of the year. The whole market had a slow start, but you know, there's a new government coming in, customers are coming back from COVID restrictions. So we see more positively for China, but also, in addition, in the rest of Asia, we're more positive about that outlook.
And then in terms of EVs, you say high double-digit percentage growth. That's, you know, higher volume in EVs. I'm curious about margins. When do you think that EVs will achieve some of the similar margins that you see on internal combustion engines for BMW?
Well, first of all, we are not unhappy at all about the current margins in the EV business. We have a lot of cars also in the upper market segment, and I think this year, 15% share of our complete volume with positive margins is already possible this year. We don't sell cars with a negative margins, and step by step, with higher volume growth and higher economies of scale, I think we are quite positive about also the contribution margin of these cars.
Oliver Zipser there, the BMW CEO, speaking to our colleague, Bloomberg's Oliver Crook, who joins us now from our Berlin studio. Ollie, what were the takeaways then for you from the BMW story?
Yeah, so we had the earnings pre-release a little bit. So again, it was all the focus on the outlook and everything, as we just heard from the CEO, it's all about growth drivers, which is going to be EVs and the premium end of things. So let's put a little meat on the bone there. So double-digit percentage growth on the high end. So that is really a very strong driver. Those are things like the BMW X7, Rolls-Royce, of course. And then in terms of the EVs, high double-digit percentage range. And of course, they also steered higher on the margins a little bit, which is another positive indicator. And despite a lot of the risks to the outlook, they say that they expect demand to be stable stable. And even in the first 2 months of this year, they saw that BMW was able to more than double its EV sales. So again, these are all sort of positive stories going into 2023. The question is, what happens in the back end of the year? You heard about the order books there. They're very, very strong. But the back end, I think there's a little bit less confidence that this is going to hold out through the entire year.
Well, Ollie, put this in some perspective for us. You had earnings from across the auto sector. What did we learn exactly about 2023 and what it's going to look like for the industry? And dare I even ask about 2024?
Yeah, well, listen, so this is the question. There's a bit of pull and push here. So you had all the tailwinds. 2023 was supposed to be a very strong year for the automakers. So all of the tailwinds, they include the backlogs that we were just talking about, premium, everything on the high end doing exceptionally well, driving growth, the U.S. being a very strong market, and China reopening. But again, a lot of them have said that they have not seen that China remains a very challenging market in the front half of the year. They hope that that improves on the back half. But then also with the supply concerns easing, while that helps the automotive sector generally speaking, what it also does is it helps across all the companies. So competition will also be rising. So does that mean that you have sort of the end of the pricing power for certainly the lower end of car makers, slowing demand globally, inflation biting probably the middle end a bit more than the luxury end? And you know, VW guided very strongly. UBS said maybe a little bit too strongly, and you have all of these unknowns going forward. So I think there's an argument for it to be a strong year, but also a weak one. IFO did a survey of German automakers. They had the lowest sentiment for the last 2 years. So again, it's a little bit unknown at this stage, but it's certainly going to be a strong front half.
A mixed bag then for the autos. Thanks very much, Oliver Crook. Bloomberg's Oliver Crook reporting from Berlin on the German autos landscape. Coming up on the programme, UK Chancellor Jeremy Hunt will deliver his first annual budget later today. It's his first big budget, even if we've heard quite a lot from him since he took over after that mini budget we won't mention too much. More on what we expect next. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in Paris today with Kriti Gupta in New York. Let's focus back on the UK, though. Later today, the UK Chancellor Jeremy Hunt will present the UK's spring budget. Bloomberg's UK political and economic correspondent Lizzie Burden joins us now from Westminster. Lizzie, good morning to you. What are we expecting from the budget today, then?
Well, Anna, it has felt a bit like Groundhog Day, but this is Jeremy Hunt's first budget officially as Chancellor. We're expecting it to be framed around three of Rishi Sunak's top economic priorities: halving inflation, growing the economy and reducing the public debt. So on the first, we've already learnt this morning that the energy support for households will be extended. We also expect him to freeze fuel duty, and then getting to the heart of the issue, the labour market inactivity that's pushing up inflation. We're expecting him as front and centre in the budget to extend childcare provision, to increase the amount that people can save tax-free for their retirement, so hopefully they work for longer, and also extending the amount of time that people can hold on to their benefits if they're long-term sick when they find a job. In terms of growing the economy, we're expecting a sweetener for business to try to compensate for the rising corporation tax that's planned for April, and this really will be presented as a budget for growth. But the question is, will he be ambitious enough? Because so far Jeremy Hunt has focused on steadying the ship. Now his MPs want him to show that he's got ambitions to point it in a firm direction.
What does that then mean for things like childcare, for example? What does the expansion look like?
Well, at the moment, there's free 30 hours for 3 to 4-year-olds. The extension would, it is reported by the Guardian newspaper last night, be extended to 1 and 2-year-olds if both parents are working at least 16 hours a week. There would also be an increase in the ratio of the number of children that one childcare provider can look after. Other tweaks in addition, but the question really is, how fast will this come in, and will the money be new money, or will it be a reallocation of money that's already there for early years spending? But this is a popular policy. It's one that Labour had been touting itself, the opposition Labour Party, and even economists that I've spoken to had said that childcare would be crucial because the UK has some of the highest childcare costs in the developed world. I spoke to Michael Saunders, the former Bank of England policymaker. He said that this could help not only to help labour market inactivity, but to grow the economy, close the gender pay gap, and indeed it might just be a vote winner with an election on the horizon.
Okay, thanks very much for that. Thanks for joining us, Lizzie Burden, our colleague there, with the latest on the UK political scene. And apologies, is that the right word for the music in the background? I don't know, perhaps a reference to UK politics. In fact, I am pretty sure it was. Right, coming up later today, we will have extended coverage of the UK budget announcement. That special is live for UK viewers from 12:15 UK time here on Bloomberg TV. Elsewhere, normal service will continue, and that normal service will just reflect on some breaking news then, Chrissy, coming through from the UK on Ukraine. The Ukraine has won a UK Supreme Court ruling over a $3 billion bond default, so it won a significant boost in its attempt to set aside a $3 billion defaulted bond. This after this UK Supreme Court ruled that judges need to consider the backdrop of Russia's campaign. Russia had been trying to argue the counter there. But Chrissy, the big focus today is really on financial services, on banking stocks in Europe, very much weaker. Credit Suisse trades considerably weaker at new all-time lows.
Yeah, and really having an effect on the macroeconomic trade as well. This isn't just about the SVB collapse anymore. We know Credit Suisse has really been struggling for a very long time, and you can actively see how aware people are. As soon as those headlines come out, yields drop around the world and futures stateside as well, falling in tandem. So you're really seeing that today's mover may as well just be the Credit Suisse developments.
Yeah, absolutely. So financial services and Credit Suisse under pressure. That stock, as you can see there, down considerably over the last 5 days. Down on the other banking stocks, though, French banks under pressure, down by more than 7% on SocGen and on BNP Paribas. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
The Federal Reserve is moving to slow inflation. That is going to have collateral damage along the way.
The Fed is going to be between a rock and a hard place. Inflation is going to be high, and they're going to find it very hard, I think, even to pause, let alone cut.
We're down to now we're kind of debating and we're pricing 0 versus 25, and I think that's very, very rational at this point.
The Fed will need to maintain credibility, will need to save face, but at the same time, dial back their hawkishness.
If the markets are in serious distress, pausing is okay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Moments ago, Credit Suisse trading at 1.99. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures stateside on the S&P 500 down by 0.8%. Credit Suisse down by 10%. Tom trading just above 2 Swiss francs this morning.
And the deposits are not going to Bank of America, which is another story in America. Is this related to American banking? No, but it also is. There's a trust and confidence issue, and you're seeing that. I looked at some fancy Bloomberg terminal bid and ask dynamics, and this is a question, John, where the headlines on CSFB, the buyers went on strike.
So we've heard from the chairman this morning, and we can talk about that in a moment. We've also heard from one of the top shareholders in Credit Suisse, Saudi National Bank. The chairman says state assistance is not a topic. Not a topic. We spoke to a shareholder about 30, 40, 50 minutes ago who said they will absolutely not provide more assistance to the bank. There is this regulatory story of being a shareholder in a company, Lisa, of more than 10%. They don't want to cross that line.
That's part of it, though. This is a Saudi National Bank chairman who is speaking on Bloomberg Television. He said the answer is absolutely not in terms of investing more in this bank for many reasons outside the simplest reason, which is regulatory and statutory. Not exactly a vote of confidence in this bank. You're seeing credit default swaps price in the greatest chance of default in the companies in the data going back to early 2000s. How much do we see some sort of threshold moment, or can they keep chugging along with this idea that they've got a 3-year plan and they're going to stick with it?
We spoke to the CEO yesterday, and Lisa, to your point, not exactly a ringing endorsement from one of your top shareholders this morning, Tom. The CEO said things were calm, the inflows were there on Monday to be seen. We don't know the story of net inflows or net flows for that matter, and we need to get some of that information. Tom, fact of the matter is, they believe they're going to make progress in Q1. We won't really find that out until we get earnings on April 27th.
It's a complexity, and what we saw yesterday is a traditional CEO that wants to stay in control by talking out the timeline. Nobody has that luxury right now. I mean, it's just not there. You have to talk about the clear and present dangers that they have.
We started out by saying, is this just an add-on to what we had seen in the U.S.? It is not. This is a specific story of a bank that's been struggling for quite a while. But it raises a question of what kind of pressures there are that build up, that create a scenario that make it very difficult for central banks to respond to the economic story at hand if they're dealing with nodes of financial distress.
Having the luxury of reorganizing in good times, Tom, is not their luxury that often arrives to some of these banks. They often face stress at tough times, and things are arguably getting tougher for financial institutions worldwide.
Well, they are. I mean, we've got some great guests lined up today to take this forward day one, but can we state that there's all clear in American small and regional banking this morning? I'm not there yet.
After one day?
After one day, there's sort of the equity markets did well yesterday, and I'm looking at some of the spreads that are doing better. 3 months to 2 year is doing a little better. Some nuances here, but I'm just not all clear out front of retail sales later.
And not for me to say, we're only a day into this, Tom, a day into a bounce. Let's see if we get day 2, day 3. Day 4, and to your point, still going to get through the data, and then Tom, we've got to get through next week. The Federal Reserve decision just around the corner too.
Well, yeah, and what's that going to be? Ethan Harris on the top there from Bank of America talking up, could we see a pause? I would say the zeitgeist right now is 25 beeps. Do we all agree on that?
Possibly. I would say it's very, very split. I would say it's very, very split. I could go through the names: Wells Fargo, Goldman, Barclays, Sam Poor's. I can pick out others that are saying 25 basis point hike. B of A is one, Citi's another, Lisa, Morgan Stanley one too.
A lot of people, including Jason Furman of Harvard, came out and said if it weren't for what we saw in the regional banks, it would be a discussion about why not go 50 basis point. The data is coming in hot enough to justify a move. The question is just whether, to your point, John, we see more distress. Have we seen the end of this? And does that change the narrative substantially?
Credit Suisse again, a break of 2, trading very briefly at 199, right there just sitting on 2 Swiss francs, 199.75. Ugly stuff. Elsewhere, equity futures down about 0.8% on the S&P. The bid comes back into treasuries. Yields are lower by 10 basis points, 358.46. Seeing a similar story over in Germany. At the front end of the curve, the 2-year, 275. Yields are lower at the front end of the curve in Germany by 14 or 15 basis points. Bit of euro weakness in the mix as well here, Lisa. Euro dollar 106.84.
Today we get a data dump, and a lot of people used to think that this was actually important before we were worried about the banking system. Now at 8:30 a.m., perhaps people will shrug it off as they have some of the other economic data. We get retail sales for the month of February. We also get U.S. PPI, as well as March U.S. Empire Manufacturing, which is always interesting as a first look at March. Do people keep spending? This, to me, is the key question. With the same robustness, even though real wages are still deeply negative, wages are not keeping up with the pace of inflation. So at what point does that eat into the demand that's fueled a lot of the inflation? At 10 a.m., we get the March NAHB Housing Market Index, home builder sentiment at a time where mortgage rates are near 7%. How much do you see it rebounding anyway? This idea that perhaps there is room to tighten more and it won't disrupt certain markets substantially that have already felt a bit of pain. And today, the earnings that we get include Manchester United, which, in another moment, perhaps we would talk about in terms of their potential sale and the Glazer family. Also Adobe after the bell. I'm curious to see the bifurcation between the haves and the have-nots, the market share consolidation in the tech giants. As we see, all of the tech giants have had a different story this year. We hear about more job cuts. We hear about perhaps a little bit over-enthusiasm in cloud computing, John. Just the earnings will tell a story that perhaps is more consistent than the macro winds that keep blowing in all directions.
Lisa, thank you. To focus firmly elsewhere right now, as you know, Credit Suisse down 11% at 198. We all, of course, know some fantastically talented people in that institution right now facing a very, very difficult time. Peter Cheer, Head of Macro Strategy at Academy Securities, joins us. Pete, let's talk about it. 197, I think we're all sort of glued on the intraday chart tick for tick at the moment. Pete, what's your take on what's unfolding?
I'm watching the CDS market. We've seen the 1-year jump to, say, 8 to 9 points up front. So someone has to pay 8 or 9% of principal to insure the credit risk for a year. Part of that's concerning because you're starting to see the curve invert. So there's a bid for front-end CDS. Having said that, I think 2 things that are mitigating that are liquidity is still just abysmal. So liquidity is low. European credit default swap liquidity is not what it once was. So the moves can be exaggerated. And it is a name that people hold so much that they do need to hedge. People have been playing around in the COCOs, various parts of the cap structure. So you do get this volatility. It is a bit concerning, though, that at it seems to be reaching new highs in terms of CDS spreads. So I'm watching that. And I think one lesson all the U.S. banks should be taking is when it comes to capital raising, you have to be aggressive and get it done early, right? There seems to be today's story is about not raising capital maybe a few months ago, and that's what's hurting them today. I think every U.S. bank that's kind of in that weaker end should be thinking, how do I raise capital? Because we in the U.S. have to fill that big void of the unmarked, unrealized losses in treasuries.
Pete, some financial institutions that some people had never heard of were declared systemically important by regulators in order to make depositors whole over the weekend in America. How would you describe the importance of Credit Suisse to the financial system?
It's an incredibly important company. It's an awesome company. It's, as you say, we all know people who are there. I think we need to see this get resolved, because the one thing we do tend to see, unfortunately, is if one gets into trouble, people very quickly start looking, oh, what's the next one that looks remotely like this? And it may be unfair, but that's kind of the pattern we saw during the European debt crisis, during the great financial crisis. I think we just saw it here in the regional banks. So this has to be a priority for the ECB and yes to get together.
Peter, I just want to cut to the chase here on contagion. I'm looking at Deutsche Bank. I'm looking at the retail French giant BNP Paribas. Same idea, they give way as well. Peter, we don't have time for the tech dynamics, but it is grim. There's no other way to put it. With John, help me here, a 194, 1.9405 on Credit Suisse. Do you look at this as a EU regulatory contagion, or is it contained to Zurich?
It should be contained to Zurich. But again, I think just like the Fed was, the ECB has to acknowledge that they've got to ring fence things and make sure that they put enough firewalls in place actually to help CS, let CS get time, but more importantly, to ensure that there's no chance of this attracting the attention of other banks and people pushing on them. That's what happened in the U.S. It's happened in the past. So, I do like what the regulators did in the U.S. I think they were very aggressive on Sunday night. I think there's more to do. They've got to address the core problem, which again is these huge unrealized losses. But it's a step in the right direction. It starts ring fencing it and making sure that people understand there is time for these things to work out.
The core problem is also, though, that regulators missed some of the red flags, not only with respect to Credit Suisse and now having to go back and rethink some of the statements as the SEC raised flags, but also over in the U.S., where there wasn't even a chief risk officer at SVB. I'm wondering, from your perspective, at what point does the market lose faith in the ability of regulators to flag risks that might emerge next?
I think one of the problems that we face is the regulators often get caught fighting the last battle. And the great financial crisis was all about the big banks, and that's where the focus was. And clearly, we've got to do more to make sure that everyone's well managed, everyone's staying within limits. I think the things that they did by the surface looks completely allowed to do. Now, why you would want to take that much duration risk, that's a separate question.
Pete, I know you like the mid-sized lenders in the United States, particularly after what you heard on Sunday evening. European banks have been a massive trade. And if we can step away from Switzerland just for a moment, SocGen's down 8%, BNP's down 8%, ING's down 6.5%. Pete, can you say the same thing about the European lenders in this moment they faced this morning?
Not yet. I prefer the U.S. right now because I think it was way overdone. It was a very isolated case, and the regulators come out quickly. So I want to see some sense that the regulators and the ECB are coming out and doing what they can. Then I think it's a buying opportunity. Again, it's been a great run. So I'm much more comfortable right now with the U.S. and the mid-market banks. That's where I want. If anything, I expect news over the weekend where you see some progress from some of these banks and shoring up their capital, whether it's through a merger or getting an infusion. That would be great for the market. So I like that. Europe, I think we got to see where this plays out. It's too early.
Hey, Pete, thank you, sir. As always, Peter Cheer there of Academy Securities. Let's get you up to speed. Credit Suisse, 189. The stock is down by 15%. It's not just a Swiss story. It's a Europe-wide story. Eurozone banks getting hammered. SocGen down 8%. BNP down 7.8%. The news of this morning surrounded the stock, the name Credit Suisse. The chairman says state assistance is just not a topic. His words. What you've heard from a major shareholder, the top shareholder, Saudi National Bank. Interested to say this out loud. They will not provide assistance to Credit Suisse. A lot of reasons. One of them is the regulatory story of going above 10% as a shareholder. That's the latest this morning. Credit Suisse is lower off the back of all of this by 15, 16%. Lower the session is where we are right now. 189, 188, the low 187. Coming up, Nuria Rabini. Looking forward to that conversation. 7:30 Eastern Time, about 1 hour and 20 minutes away.
Keeping you up
Today with news from around the world with the first word, I'm Lisa Mateo. The Pentagon says a Russian fighter jet collided with a U.S. surveillance drone in international airspace above the Black Sea, causing the American aircraft to crash. Russia's defense ministry denies the claim. The U.S. European Command says the warplane struck the propeller of the Reaper drone. The State Department is calling it, quote, a brazen violation of international law. About 500,000 British workers are striking today as unions stage a mass walkout, timed to disrupt Chancellor of the Exchequer Jeremy Hunt's annual budget. Now, teachers, junior doctors, civil servants, and workers on the London Underground are expected to join picket lines with rallies and marches planned near Downing Street and the Houses of Parliament. The capital's subway is effectively shut down over a pension, working and conditions and dispute. Japanese Prime Minister Fumio Kishida will meet with the head of the country's largest labor union today to try to encourage employers to raise wages. The talks have been attracting extra attention since Kishida called on companies to boost pay as part of his so-called new capitalism policy, asking for raises that exceed inflation, which is at a 4-decade high. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
That is the Saudi National Bank chairman rolling out further assistance to Credit Suisse, and we'll get into the nature of those comments in just a moment. Credit Suisse right now, and let's get straight to the chart, 183. We are lower by 18%. That is a session low. It is a record low. And elsewhere, you're seeing this really starting to hurt risk appetite worldwide. And we can start with the equity market in the United States. Equity futures on the S&P down around about 1%. Yields are lower by 11 basis points on a US 10-year, 357.51, not just on 10s, but on 2s, down about 9 basis points to 4.16. Want to have a little look at some European banks as well, outside of Switzerland. Let's go to France. SocGen, down 8%. BNP, down 7.4%. This was the trade, Tom. the trade year to date before the last week or so was getting long European lenders, and they're finding themselves in a little bit of difficulty this morning.
Off of the U.S., but now aggressively off of the Credit Suisse news, and basically as a generalization back to November and December. We're not in the speed of the show this morning, folks, and with a wonderful guest we've got coming up, going to dive into the details. But let me just say, we did get just moments ago new selling pressure on Credit Suisse breaking out to where it was an hour ago. But John, I want to make clear off the wonderful dynamics of the Bloomberg terminal, the buyers are on strike. With that statement by that shareholder, the buyers en masse walked away.
In many ways, it's obvious that you face new regulatory scrutiny, a new regime once you go above 10% as a shareholder in a business in many jurisdictions, and Lisa, we understand that. It's kind of strange that he said it out loud in the way he did on a morning like this after a week we've had.
You mean because he basically is torpedoing his own investment? I mean, basically, that's essentially what he's doing, because not only did he say it's not just a regulatory issue, they don't want it for other reasons as well. It raises a question why, to your point, but also this importance that it's not just one big investor. It's the big investors that people hoped would ultimately be the white knights, the Middle Eastern investors that would have some other reason to come in and shore up this bank, and they just basically are saying, nope.
The technical term is a volatility halt. That's often what happens when stocks drop too much. Tom, we're down by 18% and we have paused 183 on a stock on Credit Suisse.
We're down with the convexity, the second derivative here, looking at it on 10-minute intervals across the last 2 hours ago, is a new acceleration lower. John, you and I saw just before we went to air the breach of 2.00 Swiss francs, and the bottom line is this is sped up to where you have a halt.
The CEO said things were calm yesterday. He said inflows were coming into the bank on Monday. We weren't really clear on whether that was net inflows or not. He said they hoped they'd make progress in Q1. And I think we all sat around the table at the time and said, to find that out and wait until April 27th, Tom, that feels like a long time.
It was a long time. Yeah, it was way out to April. In Francine Lacroix's defense, she tried to drag him kicking and screaming into a CEO present analysis, and she couldn't get there. He wanted to stay focused on, you tell me, April, May, June. When you're like this, even at 3 francs per share, April, May, June doesn't matter.
Well, it's also got to lead a workforce, Tom. Keep them engaged, motivated. That's difficult at a time like this. And we open the show. I think we all know really talented people over at Credit Suisse. This morning, waking up for them, this is a difficult time watching this happen with your company. Can you imagine going to work, trying to engage with clients, pitch the message, do business with
Lisa,
them,
to me,
with the stock doing what it's doing this morning?
It's trust and confidence, Lisa. That's all there is to it. It's like the conflation of liquidity and solvency.
And this goes to this broader story of how this is becoming something systemic and really leading to risk aversion broadly, because if you've got a crisis in confidence in such a big bank, it doesn't matter kind of what the bigger story is. People start connecting the dots and extrapolating out something that's quite negative.
For you of Global Wall Street, with a trading halt on Credit Suisse shares in Zurich, 1.83 Swiss francs, we are informed by Ken Leon, with decades of experience with CFRA and, of course, helping us with American banks. Is it trust and confidence dearth in Zurich, Ken Leon? Is it basically the same as in Palo Alto or California? Is it trust and confidence lack? Is it the same everywhere?
For investors and customers, yes. And it comes in different levels. This one is concerning because it's global. And for the Fed, they're still in their domain of financial stability, which is an issue. And there's lots of new takers into this story, whether it be Congress, policymakers. What does the central bank in Switzerland say about perhaps their major franchise that has dwindled over the years? It's a pretty sad story.
Trading again now at 1.87, John, a nice lift there, but nowhere above, even on the last 10-minute interval, that would need to get to 1.92 or 1.93, and we're not even there.
Yeah, 185 is music to nobody's ears.
Yeah.
Tom, looking at that stock.
Let's continue with Ken Leon as Credit Suisse trades this morning. Ken Leon, as you mentioned, Credit Suisse, a global name. It's all part of our heritage as well. I'm thunderstruck at where Swiss regulators are. Can American regulators apply any sense of force here on a foreign bank?
They can, as it relates to their assets in the U.S. or the cooperation that you see at the highest levels of J-POW, working with other central banks around the world, the ECB in particular. So, but this one, spot on. The timeline is short. You don't have to May or June. J-POW Monday said to Michael Barr, head of supervision, is that I need a report and it will be shared with the public by May 1st. Congress will have hearings about what's happened in the U.S. with the regional banks. A lot of this is trust and confidence versus panic. And then when you get into the weeds, that's the important areas. What happened? When did it happen? What went wrong? And I'd like to share more about that because the other major part of the Fed is bank supervision.
Ken, there's a story of trust and confidence when it comes to specific issues, whether it's hedging interest rate risk or whether it's just, management missteps on consecutive years in the case of Credit Suisse. Where are the linkages beyond just simply a lack of confidence?
The weakness is really getting large banks and now smaller banks to invest in technology platforms for compliance and regulation. Michael Corbett of Citigroup for years was told to invest and he didn't. And then there was penalties and hundreds of millions of dollars spent at Citi. Wells Fargo is another example. And you take this at that scale of a global bank, Credit Suisse, it's critical to have that. It's taken us 5-7 years for all of our Goldman Sachs, Morgan Stanley to do that. But when you get down to mid-sized banks, 100 billion or more, or 10 to 100 billion, they don't have the manpower or the resources to do it like the large banks who've done it well. And on the other side is the Fed has thousands of bank examiners, but after 2018, regulation just stayed very focused and tight for those above 250 billion, not 50. And lo and behold, Barney Frank is on the board of directors of Signature Bank.
Unreal.
We're going to get theater in Congress on all this, but also the bank examiners and what the banks respond to really matters a lot.
Ken, I've got 30 seconds on the clock. There might be some people engaging in this program. Maybe they've never listened or watched this program ever before. They've watched what's happened with banks over the last week and they've taken an interest and they hear us talk about Credit Suisse and they say, credit who? They've never engaged with this lender before. They don't know what this bank does. They're seeing futures down. Ken, why does this bank matter waking up in the United States this morning?
This is a global bank. There might be counterparty risk for some of the U.S. banks. It's also, significant in the cog of the capital markets. So if it's not related to direct lending in the U.S., it does matter significantly for the capital markets. And that's where you really have to look and what it impacts in terms of debt instruments, derivatives, as well as equities.
Ken, appreciate your perspective. Really do. Thank you, sir. Ken Leon there of CFRA. Credit Suisse was halted. It was down about 18%. Resumed trading. It's now down about 16 or 17%. Session low 183. Right now 186, just off all-time lows. Equity futures down more than 1%. And a quick look at European lenders. SocGen's down 9%. BNP Paribas down about 8.6% this morning. Much more still to come. Liz Ann Saunders of Charles Schwab.
we had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is turning out to be a really, really long week. Let's work through this calmly. Equity futures down a little more than 1% on the S&P 500. Similar move on the Nasdaq, much bigger on the Russell, heavily weighted to the financials. We talked about that all through the week so far, and at the end of last week as well. The Russell's down 2%. In the bond market, we keep repricing the Fed, pricing out hikes, pricing in cuts. We're down another 13 basis points on a 2-year, 4.11. The data that matters later, retail sales and PPI. Apparently, the data that matters right now is this intraday chart right here of Credit Suisse, down more than 20%. We broke 2, broke 190, just broke 180, 177 on my screen at the moment. Session low, all-time low, 176. It spreads. Take a look at the European banks elsewhere. Going to look at the French lenders, BNP, SocGen. BNP's down about, let's call it 10% now, Tom. SocGen down 9.8%. Pretty ugly out there.
We've got such a guest that we have to get to Liz Ann Saunders, but John, I'll just say this is the first moment I can compare and contrast to March of 2008. This is not like Lehman. This is like Bear Stearns in that the Swiss government has to figure out what to do. There's truly no alternative.
So if you are just tuning in this morning and you're looking at Credit Suisse down 21% at 175, good morning to you, first of all. And secondly, let's work through the news we've had so far this morning. We heard from the chairman. He was speaking at a conference. He said state assistance is not a topic. And then we heard this from the Saudi National Bank, which is the top shareholder of Credit Suisse at the moment, just under 10% of the overall name, ruling out more assistance to the bank, does not want to go over that 10% threshold, which would include extra regulatory scrutiny. Lisa, but he said it was more than that. And I find these comments almost bizarre this morning, knowing how delicate this moment is for this name, for this bank that you hold. To say those things, even if you think them, to say them out loud, you must be aware they're going to carry some weight.
So was he trying to tank the stocks? I mean, that's
I don't know what he was thinking.
Right, but what was he thinking? To your point, though, just to build on this fragility of the moment, Credit Suisse has been under scrutiny for such a long time and has seen a flight of investors for a while. So yes, there is so much sensitivity, but there's this broader sensitivity, too, of this financial risk that suddenly has come to the fore that is completely shaking markets, and that's also leading some pretty outsized moves.
We keep going back to the data, don't we? Talking about retail sales later.
Nobody cares anymore.
His CPI came in a little bit hotter on core.
Labor market.
Payrolls headline, fantastic, great. All of that stuff lined up, and everyone thought that would open the door to 50 after what Chairman Powell said a week ago, just a week ago.
Right now, we're barely pricing in another rate hike. We have downgraded to a terminal rate of 4.8% from 5% earlier this morning. Things are moving fast in the wake of some.
The market, Tom, is saying the Fed is done.
Yeah, let's get to Liz Ann, but I would suggest strongly that this is an evolution across 3 or 4 days, and the measurement that Bloomberg reporting this morning on the billions going to Bank of America. Why will that end today? And the answer is it will not. There's no question about that. Let's get to Liz Ann Saunders. monitors with just wonderful experience in this moment, chief investment strategist at Charles Schwab. And I want to make clear, not with executive capabilities there. We will not talk to her about the challenges of the major donor to the San Francisco Museum of Modern Art. Liz Ann, good morning. And on the strategy of the moment, we have been here. What is different this time?
We have been here, but I think when you look back to 2008 and you look at what was the massive leverage throughout the entire financial system, the trillions and trillions of dollars of exposure to the alphabet soup of derivatives tied to the mortgage market, this is a different situation. Now, when you have a Credit Suisse like today, and I agree with you, I was watching when the comments came out of Saudi Arabia that we're not doing anything, and that was terribly surprising. One thing about Credit Suisse, though, and I don't cover the stock, obviously, but this stock has been in a huge downfall for 2 years. So there are clearly problems within this particular institution that predated what happened with SVB. But as a prior guest said, what we don't know yet is the counterparty risk. And I think that's clearly what's hitting the market. I tell you who I do not want to be in the next week is Jerome Powell. Boy, he is, you know, the Fed is in a very massive pickle here right now.
You have been courageous in crisis, Lizanne, to find opportunities. Just to do a compare and contrast, folks, this is off the BQ screen on the Bloomberg terminal in Swiss francs. The Credit Suisse book value in crisis is appalling. It is 0.16, I believe, is the statistic. And their compatriot, UBS, is a far larger number, 1 point, I believe it's 0.2 as well. The disparities here create opportunity. Is there opportunity, Lizanne, in the major solvent, solid banks?
I think there is, but I would expand that beyond just the financial space. I think this is an environment where, and it's not just about size being a benefit. I think within the world of traditional banking, I think there's that stability that it comes with some of the larger institutions. But I think it's really spread across sectors and industries right now. We've talked about this. You've got the return of the risk-free rate. That means price discovery. Not only do you want to try to find companies that are self-funding, that they've got strong cash flows and earnings, they're short duration equities where they don't have to access the credit markets, the capital markets, they can fund their operation. That tends to mean larger companies, but again, I'd apply it outside of just the financials. And, you know, as you know, we've been factor-based, and one of the factors we've been focusing on are these sort of self-funding companies, shorter duration companies. And I think that fits certainly within the technology space and the financial space, but I think you apply that kind of screening across the spectrum of sectors and industries. I think that's a big shift that came with the return of the risk-free rate.
Lizanne, this morning when I walked in, I was hoping that we could move on from some of the concerns around financial market stability. It seemed to make sense that there were stories that were highly idiosyncratic, specific issues at specific banks. Credit Suisse, as you said, is also a bank with specific issues that have been ongoing for years, perhaps unrelated to the tightening that we've seen in monetary conditions. And yet here we are. This is affecting everything with respect to risk sentiment. And you're right, Jerome Powell is now basically priced out of rate hikes. Yet again, even on the heels of hotter than expected CPI data on the margins. From your perspective, is the sentiment telling us something important about where we're headed and the fact that the rate hiking cycle is over?
If it's not over, it's probably very close to being over. Our bias at this point, especially with what's happening with Credit Suisse, is that the Fed will opt not to do anything, even in spite of, you know, the tick up in core CPI. I think they'll be careful not to suggest that that's it, they're done, because if you start to see some stability in the financial system, I will say that what's really frustrating to me, you guys have done a phenomenal job of reporting on all of this, but spend any time on Twitter and the misinformation that is out there, the conflating of what's gone on, the blending of FDIC and SIPC as if they're the same thing. What is the meaning of the Fed's new facility as a liquidity and funding facility? And I've seen it all jumbled together into kind of one animal. And there's a lot of people that get their information in a form like that. And that's been really, really tough. I think the 08 situation, there was just a lack of misunderstanding because it was so complicated. Here, there's sort of not simple concepts, but conflating FDIC and SIPC, which we've seen done, just looking at that is quite frustrating.
Right now, we're seeing the European stocks bank index down about 6%. I want to pick up on this, Lizanne. A Twitter-fueled bank run. That is what a number of people have called what we saw over in the U.S. Is that what you see right now with Credit Suisse that could cause or accelerate the demise of a bank that otherwise might have a 3-year plan?
I don't want to say yes or no. I don't cover the stock. I think it's premature to speculate whether we'll ultimately call this a bank run. But I think what's important and what we're seeing is not just about the power of social media and how information flow is so much quicker right now, but just how speedy changes can be made. When all the media reports and photos of what was happening at SVB showed lines, those weren't lines of depositors waiting to go in the bank to get their money out. It was mostly just gawkers. We change money, we move money digitally in an instant. And I think it's in the instant that makes this situation different than prior historical, bank runs and the like.
Lizanne, we appreciate your cool, calm and collected thoughts as always. Lizanne Saunders there of Charles Schwab. Let's return back to the stock. Stock's down more than 20%, 177. That's just off an all-time low. The words which sort of reverberate around Switzerland come from the Saudi National Bank chairman this morning, speaking to Bloomberg, saying, will you invest more? Will you offer more assistance? The answer is absolutely not, for many reasons outside the simplest reason, which is regulatory and statutory. We haven't heard from Credit Suisse this morning. We have heard from their friends across the road over at UBS. Ralph Hammers, the CEO over there, saying just moments ago, Tom, they're focused on their own strategy, won't answer hypothetical questions on Credit Suisse. But I think we're all watching the same name because it's spilling over. You look at the European names this morning, SocGen's down 9%, BNP Paribas down about 9% itself.
Particularly for those of you in London and on London Wall Street amid this bank crisis, what's important here is the timing at the Morgan Stanley conference. Mr. Hammers, I'm going to guess 550, 555 are those comments out on Bloomberg at 6:03 to our world-class speed there on headlines. John, it doesn't, it's not the hyperbole that it seems ages ago, but I think right now, after the last 38 minutes, he's going to have no comment at 6:41 here a minute from now.
So, Tom, as you know, being around for a long time, people have visceral reactions to comparing things to like 2008, 99, 2000. I don't like to go there. But one thing that frustrates me about people who do is that when we benchmark to those extremes, I think it's easy to say it's not that and then become dismissive about the moment we're in. So let's not benchmark to the extreme, benchmark to what's happened in another period and just talk about the moment we're in. Just because it's not that does not mean this is good. And what we've seen over the last week, Lisa, is not good.
And it's going to tighten financial conditions meaningfully, and that's what we've heard from people because there is suddenly a reluctance to really just lend to anyone and an increased concern about counterparty risk, and that's really the unknown here. What are the potential counterparty risks within the banking system? I mean, why else? All things being equal, the big U.S. banks should benefit from this because they can capitalize on the business, but they're not. Their shares are much lower, and this is speaking to this concern about the broader systemic risk.
Yeah, Credit Suisse, Tom, is a different beast. It's a different beast.
I am in the camp that it is a global bank with massive Asian perspective that no one's talking about. This is not another Silicon Valley. It's different and it's global.
176, stocks down 21%. Equity futures down by, let's call it 1.5% lower. We'll catch up with Simon French from Panmure Gordon very shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UK Chancellor Jeremy Hunt will pledge to drive economic growth by unblocking business investment in his first budget today. The most pressing issue for him, high inflation, weak growth, a cost of living crisis, and labor shortages. But with the UK tax burden at a post-war high, he will struggle to raise taxes or find savings. Bloomberg understands a multi-billion-pound expansion of free childcare is also under consideration. Bloomberg has learned U.S. prosecutors were investigating Signature Bank's dealings with crypto clients before its sudden seizure by regulators.
We're told officials were examining whether the New York bank took sufficient steps to detect potential money laundering. The SEC is also said to have been scrutinizing the lender. Meanwhile, the Fed is said to be considering changes to its oversight of mid-sized banks following the collapse of 3 lenders over the past week. Regulators at the U.S. Central Bank are weighing bringing capital and liquidity thresholds closer to those that apply to the big Wall Street firms. The changes would affect banks with assets between $100 and $250 billion. And inflation in Argentina accelerated sharply in February due to soaring food prices. Its CPI spiked over 6% for the month and registered a 102% increase annually. Argentina last saw a triple-digit inflation rate back in the early 1990s. Its sky-high consumer prices and severe crop drought are expected to tip its economy into recession. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding this CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
Words hurt. They hurt Credit Suisse's stock in a big way. That was the Saudi National Bank chairman speaking with the brilliant Bloomberg's Youssef Gamal Al-Din. Credit Suisse right now is down by more than 20%, 179 on the stock, 179, just off session lows of 172, all-time lows on Credit Suisse. And if we unpack that statement from the Saudi National Bank chairman, Tom, part of it is obvious. Yes, there are some regulatory things that kick in once you go above 10%. Doubt with that, that's one. Let's get to two, Lisa. Two is he said there were other reasons, and three, he said it all out loud.
Which is the real issue, and you've been bringing this up all morning, rightly so. Why would he do this? This is his own investment in a company that everyone would understand if he says he doesn't want to invest for many reasons, not just regulatory. That wouldn't be great for the share price. So at what point is this a misspeak, or at what point is this a very dramatic reaction also at a moment that's highly fraught?
Let's pause for Youssef Gamal Al-Din, who just plain and simple crowbarred it out of him. I thought it was a great interview and very terse, and this is what reporting's about. John, I would note also that finally the buyers have shown up on Credit Suisse ever so slightly, a lift from a 172 to a 17. We'll take what we can get.
Well, Tom,
right
you've got to
now.
remember there's people waking up right now, and welcome to the program, who haven't seen the stock yet, and they're thinking, you think 178 is good? They're like,
well,
we were north of 2 a little bit earlier on this week. Let's go through it piece by piece. The Saudi National Bank currently owns about 9.88% of this company. Now, they don't want to own 10, I get it, but ultimately, by the end of today, at least give it 10 minutes.
They will.
They will. You go out to the price action elsewhere. Let's start with equity stateside. Equity futures down by 1.6% on the S&P 500. If you look at how this is spilling across through the bond market, we're just pricing out the Fed even more. We're down 20 basis points now on a 2-year, 4.04%. I can bring out the German curve as well, just quickly on the Bloomberg. We're down about 32 basis points. So the 2-year in Germany is 257 at a time where some people still think maybe the ECB goes 50 basis points tomorrow. 50, really? I'm looking at European banks at the moment. They're all down. Every single Eurozone bank on the SX7E, the Euro Stocks Bank Index. SocGen's down almost 10%. Lisa, BNP's down 9.7%.
This, to me, is raising this real conundrum for central bankers, because clearly shareholders believe that there is some financial issue that goes deeper than one bank and one idiosyncratic issue. And suddenly they're piecing together into broad risk aversion. And at what point does this counteract the inflation that we continue to see in all the data? And at what point is this contagion?
I think that it is cultural, and there's somebody in the zeitgeist, I can't remember who, John, talked about, are we really seeing Swiss separation from the European continent in finance right now? What is the Swiss neutrality? How unique is Swiss National Bank? Or is it everybody in the same pool at the same time?
Some of these moves, Tom, really tough. Really, really tough.
They are. Let us go to this and get some perspective here. And yes, it's on economics, but we can fold it into the financial economics. It's in chapter 23 of Begg. That's the British textbook. Nobody ever gets to chapter 23 except Simon French, chief economist at Panmure Gordon. Simon, link the financial stresses right now to your economic world, and particularly the combination of those two for Christine Lagarde.
Yeah, there's a tightening of financial conditions that is going on in front of our very eyes this morning. And what shareholders are trying to calculate is how that passes through to a real economy that is about to, based on all the forward guidance information from the ECB, bar the odd little outlier this morning, is going to move 50 basis points. So already a tightening of financial conditions being baked in, all ahead of any contagion risk. And I hopefully was pretty honest in my note yesterday when I said we simply don't know the degree to which this is systemic or isolated, whether this was poor balance sheet management on the part of 3 tech-focused, principally US banks, or whether this is a bit like we saw in the UK back in the autumn last year, something of a canary in the mine here, which illustrates potential portfolio losses unrealized at the moment that will require capital raising down the line, which is why I think that Credit Suisse interview that you've been talking about over the last few minutes, indeed all morning, is absolutely relevant to what is focusing the minds of financials investors at the moment.
It's absolutely bizarre. I'd go one further than that. Simon, in the United States of the Federal Reserve, this chairman, people often say, is worried about being Burns and wants to be Volcker. Is President Lagarde worried about being Trichet?
It's the sell-side analogy of choice at the moment, and I think for good reason, because yes, because core inflation took longer to alight in the Eurozone, they are slower at reaching the peak. Indeed, it hasn't really peaked in the Eurozone, and therefore the policy prescription in terms of higher interest rates has come later. But it looks like very late in the financial cycle, given the events of recent days. And I think the degree to which the ECB made the strategic decision to almost pre-commit to certainly 50 in March and arguably 50 at subsequent meetings in Q2 is now looking like quite a misstep at a time when they were
wanting to move towards data dependency, they laid out forward guidance, which looks quite inflexible. So yes, I think that is a reasonable parallel to draw this morning.
Simon, let's build on that. This policy error that you highlight of indicating they are going to go 50 basis points tomorrow at a time when people are basically almost pricing them out. When you take a look at the 2-year yield in Germany, what do you think is the consequence if they do follow through on their pledge and go 50 basis points? And what's the consequence if they don't?
Well, the consequence if they do is not so much the immediate pass-through on financial conditions, but it is where the communications around that move tells us about whether actually they've stumbled across terminal rates in the Eurozone, having assumed they're about 100 up until the start of last week, more than 100 to 150 basis points higher. But the real question what one has to ask is why, given the information we have now at our disposal and the premium that is now on another few days, indeed another few weeks of data, that premium is so high, that is so valuable in terms of understanding the context, the significance, the systemic nature of this. Is it beyond the realms of possibility to do a reverse? I think it's easier for the Fed. I think it's easier for the Bank of England next week. I think it's much harder for the ECB, given where they've boxed themselves in.
Simon, we've got to leave it there. Appreciate your perspective. Simon French there of Panmure Gordon. Nobody wants to be Chairman Powell next week. You certainly don't want to be President Lagarde going into tomorrow's meeting. Credit Suisse right now is down 21% at 176. Session low is 172. All-time low is 172. If you are just waking up, I know many of you are stateside. Good morning to you. A little bit of news earlier this morning. The Saudi National Bank, biggest shareholder of Credit Suisse, top shareholder, the chairman spoke to Youssef Gamal Al-Din here at Bloomberg, was asked whether they'd provide more assistance to Credit Suisse. The answer, absolutely not, for many reasons outside the simplest reason, which is regulatory and statutory, of course, doesn't want to go over this 10% threshold, but mentioning that it was so much more than that, and also just saying all of this stuff out loud. We heard from the Credit Suisse chairman a little bit earlier this morning. He was talking at a conference, Tom, and basically said state assistance is not a topic. Of course, they're not going to say it out loud, even if it was.
The UBS executive.
We've heard from the UBS executive separately, Tom, as well, who said they don't want to talk about what's going on. This is Ralph Hammers said, won't answer hypothetical questions on Credit Suisse. I think it's important to point out this morning that it's not just Credit Suisse this morning. Futures are down, Tom, by 1.7% on the S&P.
In the last 10 minutes here, waking up in America, follow on here. I'm going to say 4 big figures on the VIX, not out to 30, but out to 28 gets my attention. John, 71 on SPX. Dow was a 600 print at one point. NASDAQ 1.6%. And we're going to get a retest right now in that dearth of buying in Credit Suisse. The little bit of breath we got here is beginning to fade away in the last 3 or 4 minutes.
And this move in the bond market, we might drop back below 4. Maybe 3.99 on a 2-year. We're very close, about a basis point away.
Wow, look
4.01% on a 2-year lease.
Wow.
We're down 24 basis points, not just stateside, but also big moves at the front end of the German curve as well.
People are saying basically the tightening that you're seeing in financial markets right now will do the job for central bankers. I'm looking at the European Banks Index, that stocks index, and it is down the most for more than a year. It's down 7%. This isn't just Credit Suisse. This is all of the banks in Europe.
It's pretty tough, isn't it? Equity futures right now on the S&P down by 1.75%, trying to stage some kind of bounce, I guess, in the last couple of minutes. In about 34 minutes' time, we'll catch up with Nouriel Rabini. Looking forward to that conversation. Futures are down, yields are lower, Credit Suisse in focus. This is Bloomberg.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
So can you talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet.
Oh, yeah. Well, and just on to sort of add on to Tracy's question, like, let's say I go to golf.com.
Yeah.
Okay. The ads that I get, like, how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, you know, the last 10 sites I went to is like pets.com or something like that.
Yeah.
And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and maybe unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that
You
problem.
bought one pair of sneakers.
Yeah,
you must
you
want
might want
more.
another one, right?
Well, I do, but I definitely don't need a second stone.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority. Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
The Federal Reserve is moving to slow inflation. That is going to have collateral damage along the way.
The Fed is going to be between a rock and a hard place. Inflation is going to be high, and they're going to find it very hard, I think, even to pause, let alone cut.
We're down to now we're kind of debating and we're pricing 0 versus 25, and I think that's very, very rational at this point.
The Fed will need to maintain credibility, will need to save face, but at the same time, dial back their hawkishness.
If the markets are in serious distress, pausing is okay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a difference a week makes. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures on the S&P down by 1.8%. One stock in focus, Credit Suisse, is down 23%. A session low. It's an all-time low, 170. We're in the 170s on Credit Suisse. The words of the Saudi National Bank chairman, top shareholder, to Bloomberg earlier this morning. Will you invest more? Will you provide assistance, Tom? The answer, absolutely not. For many reasons, outside the simplest reason, which is regulatory and statutory.
We'll show that here in a number of minutes. I thought it was telling, John, in our opening montage there, we had not one but two people that survived the Lehman Wars. Neuberger Berman and Ethan Harris, of course, was chief economist of Lehman at the time. Is this like Lehman? No, to me it's like Bear Stearns. We're like March of 2008. It's just as simple as this. When does the Swiss government step in and say this has gone too far?
The Credit Suisse chairman spoke earlier this morning and said state assistance is not a topic they're going to talk about, Tom. Of course, they're not going to talk about that publicly anyway.
Yes, of course.
But it's a difficult time, and a difficult time for many people we know who work at that institution. I'm sure many of you at home know some fantastic people there too. We're going to be very distracted trying to work today, looking at some of these moves. Outside of Credit Suisse, you're seeing the risk emerge elsewhere. Futures are lower. There's a massive bid again into the front end of the yield curve in the US. The 2-year yield is down by 18 basis points in America at 4.06%. There are no easy decisions here, Lisa, for central bank policymakers. Lagarde tomorrow, Powell next week. Lagarde had basically pre-committed to 50 basis points. What on earth do they do now?
This was supposed to be the retail sales show. This was supposed to be get back to normal. Look at the inflation. Look at the growth. Right now, it is anything but. You say what a difference a week makes, what a difference a couple hours makes, or even just minutes when you talk about the potential for more contagion risk or the fear of it within the banking system. And what you see right now is central bankers that are stuck between committing to fighting inflation, like they've said, and raising rates and saying, you know what, we're not here to protect the financial system, or potentially supporting them by not raising rates. And then the moral hazard of that. Do you just come in to rescue financial institutions? And what do you care about the average American who's still dealing with inflation? I mean, this is a rock and a hard place.
I want to make clear here, and this is just, I should have mentioned this earlier, John, to all of you, particularly in America, other networks are quoting Credit Suisse in US dollars. We do not do that. We stay quoting in Swiss francs. So you're looking at a 174, John, off a bounce of a 171 rounded, but we're quoting in Swiss francs this morning.
Without a doubt, looking at 174, Elisa, on Credit Suisse stock, and I'll go back to some of the European lenders elsewhere. We've seen SocGen, BNP Paribas, get wrapped up in all of this. SocGen's down a little more than 10%. Looking at BNP Paribas, down about 10% as well. Commerzbank, another name, Lisa, down about 9% this morning too.
Yeah, Torsten Slok of Apollo just came out with this. When the facts change, my view changes. A financial accident has happened, and we are going from no landing to a hard landing, driven by tighter credit conditions. People are looking at a new landscape driven by some of this financial concern that we're seeing in the banking industry.
I said what a difference a week makes, hey? We were talking a week ago, Chairman Powell had just had day one of his semi-annual testimony, opening the door seemingly to going 50. We were all sitting around the table, okay, how low's that bar?
Yeah, exactly.
Payrolls Friday, 311. Yesterday, CPI core hot. Going to get retail sales, no one cares. No one's even talking about retail sales this morning.
No one cares about any of the economic data because right now, that's all backward looking and the landscape has changed. As Torsten Slok said, the rapid tightening in financial conditions have really caused a backdrop that causes a potential hard landing that people are starting to price in.
This crisis and the global sense of it all of a sudden with Credit Suisse, and yes, it's a bond move, and we're very fixed income here. John, OECD just out, I believe, with their gross domestic product table. Thank you, Barbara Sklodowski, for this in London. And they're really looking at an economic, not malaise, but slowdown. And we've seen that quietly in oil. So do we have a financial crisis linked into an oil slowdown? American West Texas Intermediate, the NYMEX, just printing below 70. That is, I'm sorry, it's off the radar, John, but we've got to look at the sum of these different statistics.
Oh, it gets your attention. So yesterday's session crude was down 4.6%, down 2.5% on Monday. There is a supply side story here in the crude story this morning. The IEA put out a note a little bit earlier this morning and reported that the crude market was actually back at a surplus off the back of what's happening with Russia, Lisa, which is surprising because we came into this week and, I mean, seriously, rip up the playbook for 2023, but came into this year thinking China rebound, crude's going to do okay, Goldman looking at triple digits, and here we are south of 70 on WTI briefly.
I would argue, you said write your year ahead outlook on March 31st. Maybe you can write another one on April 30th, because right now things are moving so quickly, whether it's Russia pumping as much oil as they possibly can, or potential distress of something breaking.
Well, it's March 15th. So a few more weeks to go. 168, Credit Suisse halted again, down 25%, down 25% in Swiss trading. Got a great guest lined up, David Kelly, Chief Global Strategist at JP Morgan Asset Management. David, wonderful to hear from you and great to see you. What a difference a week makes. What do you make of what's unfolding this morning?
Well, it's unfortunately a predictable further wave after what we saw with SVB and Signature Bank over the weekend. These kinds of crises do work in waves because it's really about a confidence crisis. And what's really happening here, the Federal Reserve since 2008 has been conducting stress tests. Well, really what's happening here is the market is conducting a stress test on the Fed. How far can the Federal Reserve raise short-term interest rates given how low they were for so long without causing some damage? And we've discovered that we've now reached the limit of what the Federal Reserve can do without causing significant problems. So they should stop. I think I've heard other guests talk about how the Fed is between a rock and a hard place. I don't believe that. I think they're between a rock and a soft place because I think inflation is coming down. It will come down. This is not a fundamentally inflationary economy. So the Federal Reserve and other central banks, I think at this stage, should stop hiking and provide real reassurance that they are going to protect the financial system and deal with this this problem. I think that's really what they need to focus on.
David, the fear that's out there is personified in flows. I'm not going to ask you how many gazillions JP Morgan took in yesterday. I know you know the number, but you can't talk about it. It's a joke, folks, in crisis. But the answer, Dr. Kelly, is flows and fear matter. Where will the flows lead to? Do we lead to a place where portfolios recover, or do we lead to instability into the summer of this year?
Well, portfolios will eventually recover, and I think the key here is it's all about the inflation, actually, because people keep on talking about hot inflation, but the truth is inflation has now fallen on a year-over-year basis for 8 consecutive months. And what I think is much more important is wages are growing slower than headline inflation for 23 consecutive months. That tells me workers don't have bargaining power. Despite how tight this labor market is, workers don't have bargaining power to get fully compensated for inflation. If that's right, then inflation will gradually come down, whether we have a recession or not, no matter what the central banks do, inflation will gradually ease over the next year or two, and central banks need to just allow that to happen. And if they do, you end up back in the middle of this decade, actually where you were in the middle of the last decade, with a low inflation, slow growing economy, but a low inflation economy, which I think will support both stocks and bonds. So I think we will get there, but it's going to be a pretty bumpy ride getting there.
David, just in the moment that we're in, where people are very worried about financial market contagion, and you could say that this is a Twitter-fueled run or a Twitter-fueled kind of hysteria with people getting growingly concerned and spreading around information, how deep does it go, though, in terms of a crisis in confidence and what that means with respect to lending conditions, what that means for defaults, what that means for just how quickly this economy could come to a halt?
Well, I think there's a lot of protection for the real economy, particularly here in the United States. First of all, we still have this huge excess demand for labor, which has been keeping payroll growth strong, even though demand is weakening. And second of all, there's no real overbuild in any fundamental sector of the economy. We don't have too many houses or too much investment spending or too many inventories. So there's nothing, I think, that's going to drive this economy into a deep recession. I think lending conditions will tighten, though. And we've already seen some of that. I think we're going to see more of that. I think lending conditions will tighten. I don't expect default rates or problems with loans to increase rapidly unless you have a significant downturn in the economy itself. But I think it's just very important for authorities to remind people that we're not going to let it all fall apart. I think that's why the Federal Reserve should really, stop tightening here and just focus on that reassurance. When the Federal Reserve and other central banks are actually really good, if they put their minds to it, in controlling a crisis, if they'll focus on that. And they can focus on that because inflation is going to fade. And they just got to have enough confidence that inflation is going to fade, focus on reassuring people. We've seen a huge buildup in capital in the U.S. banking system since 2008. We do have very well capitalized banks overall, and I think the Federal Reserve just needs to provide some reassurance on that fact and on the stability of the system.
Keep saying it, a week. Feels like a long, long time in this market. David Kelly there of JP Morgan Asset Management. David, thanks for that. Credit Suisse down 20%, session low, all-time low, 168. We're just off that at 178 this morning. The stock's been hammered. Heard from Larry Fink of BlackRock, put out a letter today. Said, quote, the dominoes starting to fall. It's too early to know how widespread the damage is. We don't know yet whether the consequences of easy money and regulatory changes will cascade throughout the U.S. regional banking sector with more seizures and shutdowns. It ultimately lasted about a decade and more than 1,000 thrifts went under, reflecting on what's been happening over the last few decades in the banking system. It's a great letter if you have the chance to read through some of the quotes. Lisa, this is a tough time. I think Dan Iverson at PIMCO said it was a multi-month process we need to work through now. A multi-month process, and you've got central bankers who need to confront where we are imminently. President Lagarde tomorrow, Chairman Powell next week.
And what the dominoes are to fall. I mean, one thing that Larry Fink was talking about is perhaps the second sort of domino to fall would be in these medium-sized banks. And then the third, he points to funds invested in illiquid investments, this sort of private equity, real estate, and private credit question that people have been raising for a long time. What do central banks do?
If you are just tuning in this morning, good morning to you all on TV and on Bloomberg Radio. Credit Suisse down 20%. The chairman of the Saudi National Bank, speaking to Youssef Gamal al-Din of Bloomberg this morning, asked if he'd provide more assistance. The answer, absolutely not, for many reasons outside the simplest reason, which is regulatory and statutory, and that really putting the knife into a stock that was already struggling. The stock right now, 179.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Syrian President Bashar al-Assad is meeting with Russian counterpart Vladimir Putin in Moscow today as the Kremlin pushes for a Syria-Turkey reconciliation. Russia will also host four-way talks involving Turkey, Syria, and Iran. The potential deal opposed by the U.S. comes after China brokered a diplomatic detente between Iran and Saudi Arabia, demonstrating its newfound weight in the region. Credit Suisse's chief executive officer says the bank had seen inflows of client funds on Monday after markets and U.S. banks were pummeled by the collapse of Silicon Valley Bank.
Pretty calm. We even saw material good inflows yesterday still. Also, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at that.
Meanwhile, Credit Suisse's top shareholder ruled out providing more financial assistance to the struggling Swiss bank.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
The Saudi National Bank chairman spoke to Bloomberg on the sidelines of the Financial Sector Conference in Riyadh. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
Stunning, the Saudi National Bank chairman speaking with Bloomberg's Youssef Kamal Al-Din. Not stunning because they face regulatory issues if they go above 10%. We know that. Stunning because he said it out loud and said there were other reasons too. I'm sure that the C-suite at Credit Suisse were Not too happy about hearing that earlier this morning. The stock's on an 8-day losing streak, 181 on Credit Suisse. We're down by almost 20%. A little bit early, we were down 25. The low of the session, that's a record low now, 168. But if you're just waking up, ultimately 180. It's brutal. It's a one handle on Credit Suisse this morning, and it bleeds to the rest of the market. Equity futures down about 1.6% on the S&P 500. On the Nasdaq, we're down 1.4. The Russell, the banks, we're going to be looking at the US banks, heavily weighted to the financials on the Russell. We're down about 2.6% there. In the bond market, we're pricing out hikes, we're pricing in cuts, down 17 basis points on a 2-year in America. We came really close to going back into the threes on a 2-year earlier. We're doing the same thing over in Germany, pricing out hikes, pricing in cuts. Got the ECB tomorrow. European Central Bank's got to confront this tomorrow after basically pre-committing to 50. Who knows what they're going to do with SocGen Tom down 10%, BNP down 9.6%, Commerzbank, take your pick this morning over in Europe, down 8% there too.
Take your pick, and they have a knowledge base of what the next bank is. It's not to be inflammatory and say there's another Credit Suisse, but now Credit Suisse trading here with some kind of activity, bouncing off 1.68. This is the first time, John, I have 2 10-minute intervals, they're called, where Credit Suisse lifts off that horrific 168 level, 1.80 Swiss francs.
Tomorrow is the 1-year anniversary of the first interest rate hike of this cycle. Tom, tomorrow. And a year in, more than 400 basis points of hikes, playing catch up because this Fed was late. And this market's screaming you're done. It's screaming you're done a week after Chairman Powell seemingly teed up, opened the door at least, to go in even faster.
There are indicators of this. I go short term. I go to the land of Ira Jersey, and I look at the dynamic of 3-month paper, 3-month T-bills. They've improved the last couple days. They're not as inflammatory as they were Monday or even Friday, but we're nowhere near, anywhere near yet saying the rate regime is pulling back from the agony that caused the California mess.
Look how quickly things have changed in a few days. Torsten Slok
Apollo. Clear.
Lisa mentioned Torsten early this morning. We've been talking about Torsten for weeks, talking up no landing. Data confirmed it, at least in the early part of this year. Where's the recession? Payrolls, 311, unemployment. A month ago was 3.4%. Then we had CPI, still looked hot. Retail sales again. No one's going to talk about retail sales at 8:30 after what we're seeing. Lisa, he's gone from no landing to hard landing, just like that.
When the facts change, my view changes. That is Torsten Slok saying a financial accident has happened. And a lot of people were wondering, what is the terminal rate, since nothing has broken for so long, that it seemed like this market was so resilient, this economy was so resilient. So if nothing's breaking, maybe that terminal rate for the Fed was much higher. People talking 6.5%. And suddenly, here we are. And perhaps the market's saying, we've hit it. A financial accident has happened. Something broke. And that means we're done.
Maybe there's news pending. We will have to see, and we need to step carefully here because we have with us now someone hugely qualified in Frankfurt to speak of these dynamics and these mysteries. Jan Patrick Barnett is with Bloomberg and brings to his reporting tangible banking experience. Jan Patrick, what is the mood, the sweat, the fear that would be at the Credit Suisse headquarters, the thousands of Zurich people working for Credit Suisse? What is their angst this morning?
Well, that's hard to say, but the interesting thing to me is, like, whenever I say something critical about Credit Suisse in the last couple of days on TV, on radio, or in print, then people reached out from inside Credit Suisse to me, like, fiercely fighting for their employer and telling me all kinds about, like, what they're trying to do to make things going better. So that shows me there are still, like, passionate people at Credit Suisse. The management so far, not so passionate. And if you have your stock, like, tumbling that much, I mean, like, I guess I would be concerned working for the bank, because you simply don't know what's going to happen next, especially as this is not an isolated issue anymore. We are now moving into a more broader banking recession problem, and that's why Credit Suisse is down 20% and the others are only down 8 or 10%, because the bank now has to fight like another fire on its balance sheet, I would say. And on its earnings, and that makes the turnaround where we yesterday heard give us 3 years. I would say this 3 years has now gone to 6 years, maybe.
Jan Patrick, how shocked are you to hear the words from the Saudi National Bank chairman this morning to Bloomberg? How shocked were you by that language?
Absolutely not. I mean, the language was hard when he says absolutely not going into this. But I mean, think about it. They took part in the capital raise 3 months ago. The stock's down 50% since then. I mean, like, if you are a responsible asset manager everywhere on the world, you're not going like, yeah, sure, let's ship in another billion down the road here. That's not going to happen. So it makes total sense for me that he says, like, at this point, no, thank you. We have put enough money into this bank. Now they need to show to make it work. And again, given all the other stuff happening around the bank, why should you take this risk? It's a horrible risk-reward profile at this point.
Jan Patrick, right now I'm looking at the credit default swaps on Credit Suisse, which have blown out. That means the price that people are demanding to insure against some sort of default in Credit Suisse has gone through the roof to the highest levels that we've seen going back in history. What is the potential consequence of this for the European banking system? Are people starting to game that out of how this will look?
Well, it's a massive issue, and especially for Credit Suisse, I would say, because like now you are getting attacked from all sides. You're getting attacked from probably the central banks when they stop hiking rates, so all the rates benefits are going to fade out. Then you're getting attacked from the economic side with like your loan loss provisions most likely are going up. Then you're getting attacked from your refunding side, especially as Credit Suisse, where you have to pay higher rates to refund your business. So this overall is not great time for banking stocks, and that's why we are seeing them being sold right now. The last 3 to 4 months, everybody was taking a very comfortable position in the overall equity market, but especially in European banks, thinking like we get a grinding down of inflation, everything is safe, we get a soft landing, the economy is still doing fine, earnings are doing fine. And this whole scenario is now gone. And that's why the market reaction is so hard, in my view, because now you have to massively reprice what the economy will look like 12 months down the road. And that's why you see banking stocks, no bids there, because that's the first line of defense. Why would you own this stock moving into such a scenario? I don't see it.
Jan Patrick, do we have any intelligence whatsoever about what wealth management clients are doing right now, whether people are trying to withdraw their money or whether they're staying with Credit Suisse and saying, we appreciate the products that you provide and we're going to be your clients for a longer period of time?
Well, I guess it doesn't really matter. I mean, like if they take away the money or if they just like put it into a safe space, the consequence for the Credit Suisse will be the same. I'm not so much concerned that they are losing deposits that have a liquidity issue. I would say there are other options in Europe where they can get liquidity from, and I'm pretty sure central banks will provide that. But the bigger issue here is like, no matter what way your wealth management clients are doing, they will reduce risk. That means less fees, that means less revenue, that means less earnings, that means less prospects for the stock price. So again, why buy the share in this situation? No incentive whatsoever.
Jan Patrick, final question. Lisa and I talked about it a little bit earlier this morning. What would spook this market more tomorrow? If the ECB went 50 or didn't?
Well, that's the interesting question I want to know, and I'm not so sure what it is. Like, it's going to be horrible for central banks at this point because you have to put out 5 fires with just like 1 bucket of water. So I guess what they will try to do is like bring across the message to say like, okay, we've noticed that there's something going on that is not nice, and we take this into account going forward. We will be less data dependent. We believe that inflation is going to come down anyway, especially if economic activity is now going down. And we will try everything to ensure that liquidity flows, especially in the banking sector, but across the economy, to make sure that we are not getting like a hard landing, that we are not hitting the wall. But this communication we know is like very difficult for central banks to pull off, to make markets happy. So it's going to be very interesting to see how they want to do it. But if I have to make a bet, I would say no matter what they say, the market won't be like super happy because they're not putting out the bonanza at this point. I'm sure they never do in the first commentary, right? They always wait a little bit longer. But the market wants like the big measure, and they're not getting that.
Jan Patrick, thank you. Jan Patrick Barnett there. Credit Suisse and going into central bank decisions. If you want to make a fool of someone right now, Tom, ask them for a forecast. The ECB's got to do that. The Federal Reserve's got to do that in the next week.
I 100% agree. The uncertainty is just in every facet. No forecast.
Futures right now on the S&P down 1.6%. Nourian Rabini up next.
so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Equity futures right now on the S&P 500 down by 1.6% on the S&P. The thing you need to watch right now is Credit Suisse down by about 20%. Credit Suisse getting hammered this morning. In and around 180, session low, all-time low, 168. The story with the name this morning. First of all, we heard from the Credit Suisse chairman who ruled out state aid, not a topic they want to discuss, hardly a surprise. This was surprising in more ways than one. We heard from the Saudi National Bank chairman who said they will absolutely not provide more assistance to Credit Suisse. Mentioned the regulatory issue of going above 10% as a shareholder. I think we all understand that, but said there were other reasons as well, for many reasons, outside the simplest reason, which is regulatory and statutory. That's not helped out this name. It's an 8-day losing streak, 180 on Credit Suisse. Talked briefly about futures, taking some pain in America. We're down 1.6%. Given the moves we've seen over the last week, that's not a monster move, is it? On the NASDAQ, we're down about 1.3%. The 2-year bond in America has traded like a penny stock over the last week. It's down 22 basis points on a 2-year, very close.
Pink sheets.
Very close to 3.99, Tom. 4.03%.
4.03,
on a 2-year.
unreal.
Amazing.
To get a 3.99 there. We're watching American oil near 69 handle. John, I just need to bring us up to date on the 10-minute intervals on Credit Suisse. Yes, a bounce, but just up to one comfortable moving average. And now is where we see a real retest at 1.80. Do we go back down and look at 168, or do we actually get to a better place?
Deeply uncomfortable for that company this morning. The moves you're seeing in the bond market, we're pricing out rate hikes, pricing in rate cuts, not just in America, but in Europe too. Looking to Germany, the 2-year yield is much, much lower this morning. Tomorrow, ECB President Christine Lagarde, Elisa, has the unenviable task of working through these issues after seemingly pre-committing to a 50 basis point rate hike, and now seemingly also stuck between a rock and a hard place. Because when we asked this question this morning, what would spook this market more, if they went 50 or if they didn't?
And what does that mean about their visibility, their credibility, and their willingness to back up a financial system at a time when other people say that the broader economy is still doing really well and perhaps too well with respect to inflation? It's not just Credit Suisse. And this, I think, was making it very difficult. You're talking about bonds, you're talking about stocks. Take a look at European banks. If you look at the specific banks, SocGen down more than 11%, BNP down more than 11%, Commerzbank down almost 10%, UBS down 7%. If you take a look at the banking index as a whole in Europe, it's down about 7% for the biggest drop going back a year. We're looking at a situation, John, where people are trying to extrapolate out what it would mean with respect to counterparty risk, with respect to other risk that might not be seen, that's exacerbated by the rate hikes. They're trying to game that out both in Europe and in the US, and then putting that into a scenario that used to be inflationary and now suddenly is not.
It's so difficult, Lisa. No one knows. And Tom, for that reason, you de-risk and ask questions later. And that's what you're seeing develop this morning with European banks. And I have to stress this. We've had guest after guest now for weeks, months, talk up the trade of the year so far, which had been European banks to this point.
In the crisis that we're in, you look to institutions, and I think everyone, as John Patrick Barnett just said, we're waiting for regulatory authorities to speak. They did that in America in a measured way, John. You and I and Lisa watched that tick by tick with Shonali Basak and others over a long weekend. In Switzerland, I suggest there's silence. You know, there's no other way to put it. Right now, we're going to do, John, continue to monitor Credit Suisse because I think
I'll keep working at Bloomberg. Credit Suisse right now down 21%, Tom, 177.
It's going to be interesting to see. We are well timed here. Joining us is David Rubenstein. You know him, of course, from the Carlyle Group, his public service to the nation in the Carter administration. And David Rubenstein, peer-to-peer conversations. And as David knows, I want to say, we'll rip up the script. Today, we're going to rip up the script. I've got 8 ways to go here. You, with your philanthropy, have a wonderful linkage between financial elites and the government. In America, we've seen the government begin to step in this crisis. Are you surprised that European and particularly Swiss authorities have not stepped in on Credit Suisse?
I am surprised that nothing has happened yet, but it took a day or two for the United States to get its act together, so I suspect it'll take a day or two there. But remember, the U.S. regulatory scheme is much different than the Swiss one or the European one. And so we have one regulatory scheme, more or less, in the United States. They have many different ones in Europe. And I don't think the Swiss authorities have quite the authority over the banking system that the U.S. one does have over our banking system.
David, that's what I wanted to go to. What would you suppose stepping in looks like in Switzerland? What does that look like?
Well, what we did in the United States is we protected depositors. So we didn't protect creditors, and we didn't protect shareholders, and we didn't protect really employees. I suspect the Swiss situation is more complicated because the existence of the bank is more at stake here, and it's such a well-known bank around the world that I think the Swiss authorities have to worry more than just about the depositors. The chairman of the Saudi National Bank, who I do know, made a statement that you broadcast recently saying that they were not going to put more money in. And that would probably a bit of a blow to Credit Suisse.
Were you surprised by that he said that out loud on the record?
I was surprised by it. I just saw him a few weeks ago, and I think they have a lot of authority in the Saudi National Bank, and I suspect they wanted to protect their investment, but obviously there's a reason why they're not doing that.
Well, there's a theory that perhaps Middle Eastern investors would want to come in and help Credit Suisse more substantially, not just because they think it's a good investment, so that they could do business and have that be the European node. Is that basically off the table based on the very public comments that we heard earlier this morning?
I don't have enough information to say that that's the case. I was surprised that the Saudi National Bank chairman did not want to put more money in, but he may be under some regulatory constraints to put more money in. So I just don't have all the facts there. But I do know that there's a lot of Middle East interest in Credit Suisse, and over the years there have been a lot of activity between the Credit Suisse and Middle East bankers and Middle East investors. We'll just have to wait and see.
David, you said that this is more complicated because of all the interconnectedness of Credit Suisse and the global banking system. And I'm wondering what your concern is, whether you think that the worry in markets is warranted based on how systemic it really is.
Well, I think in the United States, the regulators thought over the weekend they had solved the problem. Clearly, they haven't really solved the problem because some banks are still weaker than they would prefer to be. I think the contagion that spread to Europe is something that the regulators here probably did not anticipate. And so we'll just have to wait and see what the impact is. Right now, the U.S. banking system is in pretty good shape. There's obviously some weak banks, but basically we don't have a systemic run on the major banks in the United States. I would say that Credit Suisse is a major bank in Europe, not as important as it was many years ago, but still an important bank. So if it were to have serious problems, it'd have more of a contagion effect than Silicon Valley Bank would have on our banking system.
Some people talk, other people do. In March of 2008, you did. Carlyle Capital, to be polite, was challenged, to be polite about it. You stepped up verbally and with action to help make people whole. How do we affect that now with this complex crisis that we have?
Well, that was something that was unanticipated by many people. It came about in part because the concerns about the regulatory system and interest rates were going up. I think here the Federal Reserve probably did not spend as much time worrying about the impact on banks and their ability to survive when interest rates were going up. The Fed was mostly focused, I think, on inflation and not worried about the bank regulatory system. And I think they may have been caught unaware of how serious the problem was.
So what should Powell do here? These are delicate questions. I don't want to put you in a corner, Mr. Rubenstein, but you've got tangible experience here.
Well, my experience may not be that relevant for this, but I would say the big decision that has to be made by the Federal Reserve is, do they increase interest rates by 50 basis points, 25 basis points, or no basis points? And the conventional wisdom in Washington today, and that conventional wisdom is not always right, is that the Fed will probably go with 25 basis points. If they were to go with no increase at all, people would think that they've lost their interest in fighting inflation. They go with 50 basis points, it might be seen as too much for some of the banking companies right now. So I suspect 25 basis points is the split the baby decision that's most likely.
Meanwhile, earlier this morning, we got this letter from BlackRock's Larry Fink, and he was talking about potentially a slow-rolling crisis in the U.S., with the first shoe to drop, Silicon Valley Bank, the next with some regional banks, and then he pointed to a third shoe to drop, where he pointed at private equity, and he pointed to some of these less liquid assets that have built up in size over the past few years. Do you agree that that could be a node of concern in the next couple of months and year ahead?
Private equity is not the same situation as banks. We don't have typically runs on private equity firms. And so the private equity firms did quite well in the last recession. They survived it and they came back stronger than ever. The private equity firms are much bigger than they were the last time around. So I don't see any weakness at all that we have to worry about in terms of a regulatory situation with private equity firms. I think we're not the problem. I think other banking regulated companies may have bigger problems, but not private equity firms, in my view. Clearly, private equity firms have illiquid assets, but we've known that for a long time, and we don't have a run on the bank where we have depositors pulling their money out anytime they want to do so. So that's not a problem for us.
We had a run on the bank elsewhere, and the decision that was made by authorities was to make depositors whole. We understood there was an FDIC limit on deposits of $250,000. It looks like that's gone. Ken Griffin, I believe, spoke to the Financial Times recently of Citadel and talked about maybe eroding